Yes, sir. Issue of bonus shares. Issue of bonus shares. Section 63 of Companies Act. Section 63 of Companies Act is governing the issue of bonus shares. Okay, sir. Fine. What is this issue of bonus shares? Sir, bonus shares are the free shares issued by company to its equity shareholders at free of cost. Bonus shares are the free shares issued by the company to its equity shareholders, existing equity shareholders out of existing free at free of cost. Next, bonus shares are given only to equity shareholders. Bonus shares are given only to equity shareholders. Next, sir, whenever a company issuing bonus, they need to follow certain. First of all, what is this bonus means? This is the other name is capitalization of reserves or capitalization of profits. Capitalization of reserves or capitalization of profits. Okay, sir. Sir, bonus shares are given only to equity shareholders. Yes. From where this bonus shares has to be given? Yes, we can see. Before going into that, come to the effects of bonus issue. Effects of bonus issue. First one, number of shares increases. Number of shares increases. Yes, sir, number of shares increases. Share capital increases. Share capital increases. But there is no increase in net worth. But no increase in net worth, sir. There is no increase in the net worth. Increase is there in where, sir? Number of shares will be increased, share capital will increase, but net worth will never get increased. EPS will get decreased, sir. Market price will get decreased, sir. Are getting, sir? EPS will get decreased and market price will get decreased. In other words, it will have increase in where? Number of shares will increase, share capital will increase, but there will not be any increase in where? Net worth. Next one, EPS will get decreased, market price also will get decreased, and this is a positive indication in the market. In the market. So, number of shares will get increased and there is also one more, sir, reserves will get decreased. That is the whole concept. Reserves will get decrease. Wages will get decreased. Yes, sir. This is also known as capitalization of what, sir? Reserves. See what is this bonus and how these reserves are decreasing. Let's see. Before going into that, there are certain conditions which are to be complied as per section 63. First one is there should be an authorization in articles. There should be an authorization in articles of association. There should be an authorization in articles of association. Yes, sir. Next one, there should be authorization in where, sir? Articles. And second one, board should pass. Board have to pass what, sir? A recommendation. For what? For this bonus, where in the shareholders, in the general meeting law, shareholders has to be approve. In other words, shareholder has to authorize. Shareholders has to be authorized in general meeting. Shareholders has to be authorized in where, sir? General meeting. Board should recommend whom? To the members at AGM for authorization of this bonus issue. Yes, sir, by passing an ordinary resolution. Next, AOA. Yes, sir. Next one. There should not be no default. There should not be no default in payment of. There should not be no default in payment of principal or interest. There should not be no default in terms of what, sir? Principal or interest. In respect of creditors or fixed deposit, in respect of fixed deposit or any debt securities by the company. There should not have any default. That is the ultimate issue. Next, there should not be no default in statutory dues. No default in statutory dues. No default in statutory dues. Okay, sir. Next. Yes, sir. So, if you want to make a bonus issue by the company, make sure that no default in statutory dues relating to employees. Like what, sir? Like what? Like PF contribution, like bonus, all these things. Bonus means not this bonus, sir. Any salary bonus, all these things. There should not be any statutory dues in respect of employees. Next, there shall not be any partly paid up shares. There shall not be any partly paid up shares. Okay, sir. All these partly paid up shares has to be made it as fully paid up if you want to give bonus issue. And this bonus is not in lieu of dividend. This bonus is not in lieu of dividend, and no withdrawal of the definition. No withdrawal of decision. No withdrawal of what, sir? Decision. If you want to give bonus, now once today I announce bonus, tomorrow no bonus, like that it is not possible. Once the decision is made, once it is recommended, and once it is approved by board of directors, and once it is declared in AGM, you cannot wear back. Next one, any other condition as may be prescribed. Any other condition as may be prescribed. Okay, sir. Next, these are the conditions as per section 63. So, if you want to give bonus, these are all the conditions, sir. Next, there are two types of bonus. One is bonus issue, one is bonus call. One is bonus issue, one is bonus call. Bonus issue, bonus call. This bonus issue is issue a fully paid up share as bonus, issuing fully paid up share as bonus. This is converting partly paid up share as fully paid up, converting partly paid up share as fully paid up, converting partly paid up share as fully paid up share as bonus call. Converting partly paid up share as fully paid up share is known as bonus call, and giving one fully paid up share, issuing a share, is known as bonus issue. That is governed under section 63 subsection 1. So, to the existing equity shareholders, in proportion to their paid up capital, we are giving bonus shares to the existing equity shareholders. Okay, sir. Next. Next one, sir. Sources from where you will give this bonus. Sources. Sources of bonus issue. From where you will give this bonus issue. Sources. That again depends upon whether it is bonus issue or bonus call. Yes, sir. Sources of bonus issue once again depends upon whether it is bonus issue or bonus, call. If it is bonus issue, then CRR, capital redemption reserve, which I already discussed at redemption of preference shares. What is this CRR? Next, securities premium. Next, capital reserve realized in cash. Next, journal reserve, P&L balance, credit balance. Next one, dividend equalization reserve. These are the reserves from where you can issue what? Bonus. That is the reason capitalization of what? Reserves. Capitalization of reserves is known as what? Bonus issue. Is known as bonus issue. Now bonus call. For bonus call, what and all the reserves I can use? For bonus call, you can use only capital reserve realized in cash, journal reserve, P&L and dividend equalization reserve. Now bonus is bifurcated into two. One is bonus issue. If I want to issue bonus issue, the existing shares must be fully paid up. Fully paid up. Bonus call. When the existing shares are partly paid up, convert the partly paid in shares into fully paid up shares by way of bonus call. Once they are fully paid up, you can give what? Bonus issue for them, bonus shares for them. But until it is fully paid up, do one thing, convert that partly paid up into fully paid up shares. I hope you are getting the clarity. Next. Next, sir, are getting, sir. So what I have covered? So bonus shares are the free shares issued by whom? Bonus shares are the free shares issued by the company to its equity shareholders at free of cost in proportion to the shareholding. In proportion to their shareholding. In proportion to their shareholding. Now, because of bonus issue, the ratio in which the existing shareholders are holding shares will not have any impact. Before bonus issue, what is the ratio they are having? Even after the bonus issue also, the existing shareholders will have the same ratio in which they are sharing, in which that shareholding ratio pattern in which they are holding their shares. This is also known as capitalization of reserves. How it is a capitalization of reserves? See, all reserves are decreased, and from this reserves I am converting into what? Capital. So this is known as capitalization of reserves. Come to the accounting entries. Come to the accounting entries. For bonus issue, reserves account to debit, decrease your reserves, whether it is CRR or it is securities premium or it is capital reserve or it is general reserve or it is P&L or it is dividend equalization reserve. Two, bonus to shareholders account, bonus to shareholders account, bonus to shareholders account. This is when, sir? On the date of declaration of bonus, on the date of declaration of bonus. On the date of allotment, on the date of allotment, cancel this bonus to shareholders, cancel this bonus to shareholders to create what? Equity share capital, equity share capital. These are the entries. What? Reserves are decreasing, capital is increasing. That is the known as capitalization of what? Reserves. This is for what? Bonus issue. Now come to the entries for bonus call. Journal entries for bonus call. What is this journal entries for bonus call? Entry. Reserves. Reserves means what are the reserves here? Reserves means what are the reserves, sir? First one, general reserve, capital reserve, first one, realized in cash, and then general reserve, and then P&L account, yes sir. Moving to journal entries for bonus call. Okay, journal entries for bonus call. Entry, sir. Two reserves you are not supposed to use. What are those? CRR can be used only for the purpose of what? Issue of fully paid bonus shares. Securities premium will be used only for the purpose of issue of fully paid bonus shares. For bonus call, you are not supposed to use what, sir? You are not supposed to use your CRR and securities premium. You can only use your capital reserve, which is realized in cash, which is realized in cash. And you can also use what? Journal reserve. You can also use what? P&L. And you can also use what? Dividend equalization reserve. Now entry, sir. So you have to reduce all these reserves. Entry. capital reserve account to debit, capital reserve account to debit, next general reserve account to debit, P&L account to debit, dividend equalization reserve account to bonus to shareholders account. I hope you are getting the clarity. Now make final call, entry for final call, equity share final call or whatever the call it may be, account to debit to equity share capital. Cancel this liability, cancel this asset entry. Bonus to shareholders, bonus to shareholders to equity share final call. Equity share final call. Are you getting, sir? Yes, sir. When it is bonus issue, what is the entry? Reserves account debit to bonus to shareholders and then bonus to shareholders account debit to equity share capital. Done. It is not what? Bonus issue. It is what? Bonus call. If it is bonus call, what is the entry, sir? If it is the bonus call entry, reserves except those CRR and securities premium to bonus to shareholders. Equity share final call account debit to equity share capital. Bonus, whatever the liability you credited, now debit that. Bonus to shareholders account debit to equity share final call. I hope you are getting the clarity for this. Next. Yes, sir, this is the basic entries. Now we can also solve one problem. We can solve one problem on this. Come to CRD 3. Come to CRD 3. Yes, sir. Open that. Yes. Sir, what is the question, sir? Yeah. The following notes pertaining to what, sir? Balance sheet of Preet Limited as on which date? 31st March 2022. Share capital, authorized share capital how much? 1,50,000. Authorized how much? 1,50,000. Okay. Preference shares. Equity shares. Very good. Authorized capital. Next, issued and subscribed capital. What? Issued and subscribed capital. 12 lakh and 1,35,000 and out of 10 only 8 paid up and 10 is fully paid up. I hope you are getting the clarity. Yes, sir. Authorized of 15 low, 12 preference shares issued. Authorized of 1,50,000, 1,35,000 equity shares were issued. Next, reserves and surplus low. First one, general reserve. Second one, CRR. Third one, securities premium collected in cash. Very good. Fourth one, profit and loss account. Next, on 1st April 2022, when, sir? On 1st April 2022, the company had made final call at the rate of 2 each on 1,35,000 equity shares. What company made, sir? Company made final call at the rate of 2 each on 1,35,000 equity shares. The call money was received by 20th April. Perfect. Call money was received by 20th April. Call money was received by 20th April. Perfect. Means it is not converting your partly paid up share into fully paid up share by way of bonus issue. This is what, sir? This is, I am raising that final call. Thereafter, the company decided to capitalize its reserves, which is known as bonus, by way of bonus at the rate of 1 share for every 4 shares held. 1 share for every 4 shares held. Yes. Come. What they are asking? They are asking you to prepare journal entries and they are asking you to prepare extract of the balance sheet. Working note number 1. Calculation of number of bonus shares to be issued. Now tell me, sir, how many existing equity shares were there? 1,35,000 existing equity shares were there. 8 each and 2 were called, hence fully paid up. Number of equity shares how many? 1,35,000 shares. Next, bonus ratio 1:4. 1 share for every 4 shares. Bonus shares is equal to 1,35,000 divided by 4 into 1. 1,35,000 divided by 4, which is 33,750. Which is 33,750 bonus shares we will issue. Are you getting, sir? Perfect. How much amount required for bonus? Amount to be utilized from reserves for bonus. Amount to be utilized from reserves for bonus. Amount to be utilized from reserves for bonus. 33,750 shares into 10 per share. 10 is only issue price. Hence, how much you required? Yes. How much you required? 3,37,500 you required. I hope you are getting the clarity. I hope you are getting this clarity. I hope you are getting the clarity for this. Next. Now pass the journal entries. No working note is required. Working note 1 is done. Now pass the journal entries in the books of journal entries in the books of, who is this? Journal entries in the books of Preet Limited. Date, particulars, LF, debit, credit. Date column, what is the date you are supposed to write? 1st April, company made the final call. 1st April 2022. Equity share final call account debit. Equity share final call account debit. Equity share capital. How much? 1,35,000 shares into 2. If I am not wrong, 2,70,000. 2,70,000 and 2,70,000. Next, on the same date, amount collected on 20th April, if I am not wrong. On 20th April, amount collected on 20th April. Being final call made. Next one, 24/20/22 entry bank account to debit to equity share final call. Equity share final call. How much? 2,70,000. 2,70,000 being final call amount received. You don't write, you are not supposed to write FC, write final call, FINLC. Next, what happened? Therefore, the company decided to capital its reserves by way of bonus for 1 share for every 4 shares held. Okay, as the absence of date, don't write any dates column, write. You want how much? 3,37,500. And what are the reserves is available with you? CRR exclusively used for that purpose. You want 3,37,500. And in this 3,37,500 low, 60,000 is what? CRR. And securities premium is how much? 37,500. Next, P&L is how much? 3 lakhs. Means how much is sufficient? 2,40,000 is sufficient from P&L. Yes sir, 2,40,000 is sufficient from P&L, or you can also take general reserve. In any proportion. Better take from general reserve 180. Then how much left? 180 plus 60, how much? 240. 240 means you required another 60 from P&L. Are you getting, sir? Entry, sir. Entry CRR account to debit 60. Securities premium account debit 37,500. Next, general reserve account debit, P&L account debit to bonus to shareholders. CRR account to debit. Securities premium account to debit. And then general reserve account to debit. P&L account to debit. So, bonus to shareholders account. CRR lo how much you can use? 60. Use 60. From securities premium 37,500. 37,500. From general reserve 1,80,000. 1,80,000. From P&L 60,000. 60,000. 2. Bonus to shareholders 3,37,500 being bonus shares announced. When you are allotting the bonus shares to the bonus shareholder, existing equity shareholders, entry bonus to shareholders account to debit to equity share capital. How much? 3,37,500. 3,37,500. 3,37,500. Next, they are asking you to prepare the extract of balance sheet. They are asking you to prepare extract of balance sheet. Balance sheet, equity and liabilities. First one, shareholder funds. First one, share capital. Second one, reserves and surplus. Notes lo 1, 2. Anything else they are provided? Yes. Yes. Very good. Yes, sir. Now, the before the share capital is how much? Preference shares 1,20,000, that remains 1,20,000. Next, 1,35,000 into 10, which is 13,50,000. Next, bonus lo 3,37,500. Right? Right. 3,37,500. Total 1,20,000 plus 13,50,000, which is 14,70,000 plus 3,37,500, which is 1,08,000. 18,07,500. 18,07,500. 18,07,500. 18,07,500. And total reserves comes to how much? Earlier 1,80,000 and then 60 and then 37,500 and then 3 lakhs minus how much you utilized? 3,37,500. Balance left 2,40,000. In the reserves and surplus low, you will have 2,40,000. And this 18,37,500 comprising of what? Comprising of ten lakh 80,000 plus 1,20,000 plus 3,37,500 plus 2 lakh 70. Perfect. 18 lakh 7,500. This is comprising of this amount plus this amount, and on final call 2 rupees and one more, that is 3,37,500. I hope you are getting the clarity. Now give notes. Give notes. Notes. First one. Per share capital. First one is what? What is the authorized capital? Yes, sir. 1,50,000. How many shares you issued? 1,35,000. What are the bonus shares? 37,500. 33,750. 33,750. How much? 1,35,000 plus 33,750, which is 1,68,750. This 1,68,750 is crossing what? This 1,68,750 is crossing what? Authorized capital. Provide in terms of note. As that authorized issued capital is more than authorized capital, as the issued capital is over and above the authorized capital, necessary resolutions is passed in the general meeting for increase in what? Authorized capital. That note you have to provide. Note. As the issued and subscribed capital is more than what? Authorized capital, necessary resolutions were passed in the general meeting to increase your authorized capital. Now, authorized capital, how much? 1,67,500 shares of rupees 10 each. 1,67,000 only of equity shares I am talking. This is all about equity shares. First, up to this completed. Any doubt, please ask me. Any doubt, please ask me. Yes. Any doubt, please ask me. Yes, sir. The following is the balance sheet pertaining to Preet Limited as on 31st March 2022. Yes. Share capital, authorized capital, 15,000, 12% preference shares of 10 each, 1,50,000. 1,50,000 equity shares of 10 each, 15 lakhs. Now, 16,50,000. Very good, sir. Issued and subscribed capital. What? Issued and subscribed capital. 12,000, 12% preference shares of 10 each fully paid, 1,20,000. 1,35,000 equity shares of 10 each, 8 paid up, 10,80,000. Are you getting, sir? Yes, sir. Now you are having reserves 1,80,000, capital redemption reserve 60, securities premium collected in cash 37,500, profit and loss account 3 lakhs. On 1st April 2022, the company had made a final call of rupees 2 each on 1,35,000 equity shares. Yes, they are clearly telling 1,35,000, 10 each, 8 paid up, means they are having an option to call this as bonus call or raise an amount. They are raising the amount. They are raising the amount of rupees 2 each. Entry. On which date? 1st April 2022. In the books of, in the books of, who is this? Preet Limited. Next, journal. Date, particulars, LF, debit, credit. Date, particulars, LF, debit, credit. On which date? On 1st April 2022, company made a final call. Entry. Equity share, final call, account to debit to equity share, capital. How many shares were there, sir? 1,35,000 into final call is how much? 2 rupees. Means how much? 1,35,000 into 2 per share. 2,70,000, 2,70,000, 2,70,000 being final call made. Being final call made. Entry, sir. On 20th, on 20th call money is received, 20 April 2022. On 20 April 2022. How much is the call money received? Bank account to debit to equity share, final call. How much? 2,70,000, 2,70,000 being final call amount received. I hope you are getting the clarity. Next what happened? Now thereafter company decided to capitalize its reserves by way of bonus at the rate of 1 share for every 4 shares held. 1 shares for every 4 shares held. Draw one working note. Leave some 7-8 line space for leave some 7-8 space. What is the requirement of the question? They are also asking balance sheet and prepare the extract of balance sheet. Okay. So leave some 10 lines space and have one working note. Why 10 lines? Means 2 entries for bonus and some 5 to 6 lines for extract of balance sheet. Working note number 1. Calculation of, working note number 1, calculation of number of bonus shares to be issued. Existing number of equity shares. Existing number of equity shares. How many were there existing number of equity shares? 1,35,000. Ratio of bonus. Bonus ratio 1 share for every 4 shares held. Bonus ratio 1:4. Number of bonus shares. One lakh 35,000 divided by 4 into 1. 1,35,000 divided by 4 into 1. 1,33,750. What is this 33,750? Number of bonus shares. I hope you are getting the clarity. What is this number of bonus shares, sir? This is 33,750 is the number of bonus shares. Now tell me, sir, amount required to be transferred from reserves, amount required to be transferred from reserves, amount required to be transferred from reserves to capital. Amount required to be transferred from reserves to capital. How many shares? Into face value per share. Now 3,37,500. What I am supposed to do this 3,37,500? I need to transfer from where to where? Free reserves to capital. That is what my capitalization of reserves. Those reserves I need to capitalize, which is in the ratio of 1:4. Now, as the date is silent, okay. Thereafter, company decided to capitalize this reserve, okay. Come and see what is the CRR. Always first choice is CRR. CRR account to debit. $60,000. CRR account debit 60,000. Securities premium realized in cash 37,500. The next choice is securities premium in the order. How much? 37,500. Next one. Profit and loss account credit balance, any other reserve is general reserve. You can use in any way. So first touch general reserve 1,80,000. How much you required? 3,37,500. So touch. You are supposed to write general reserve account debit 1,80,000. Now 60 plus 37,500 minus 3,37,500. 60,000 is required from where? P&L. So, bonus to shareholders. Bonus to shareholders. Bonus to shareholders. How much? 3,37,500 37,500. Being issue of being announcement of bonus shares. Being bonus shares announced. Next, bonus to shareholders account to debit. To share capital, equity share capital. How much? 3,37,500. 3,37,500. I hope you are getting the clarity. 3,37,500. Next, draw on balance sheet. Extract equity and liabilities. Equity and liabilities. First one, shareholder funds. Inside that, share capital. Next, reserves and surplus. Next, reserves and surplus. Next one, any long term borrowings is there? Enough, I think. Extract of balance sheet, what they are asking, only to the extent of prepare extract of balance sheet. Okay, after, yes, enough. Notes 1, 2. Notes to accounts. First one, authorized capital. How many shares is the authorized? 15,000, 12% preference share for 100 each, 1,50,000. In which lo do one thing. Yes, sir. Authorized capital 15,000, 12% preference shares of rupees 10 each, 1,50,000. Next one, 1,50,000 equity shares of rupees 10 each, 1,50,000. Draw one line. Second one, issued and subscribed. How many shares issued and subscribed? 12,000 and 1,35,000. Yes, sir. While writing this authorized of 1,50,000, 1,35,000, but 37,000, 1,35,000 plus 37,500, which is 1,72,500 total. 1,72,000. $1,70,000 equity shares of rupees 10 each. Yes, sir. The following is the balance sheet of what? Preet Limited. Okay. As on which date? As on 31st March 2022. This is the balance sheet. They are telling 15,000, 12% preference shares of 10 each. Okay, this is authorized. So beyond that you can't issue unless you are passing necessary resolutions. 1,50,000 equity shares of 10 each. For example, because of bonus issue, your number of authorized shares increasing means you are supposed to pass one ordinary resolution in the general meeting to increase in your authorized capital, right? 12,000, 12% preference shares of 10 each fully paid up how much? 1,20,000. 1,35,000 equity shares of 10 each, 8 paid up. You are having authorized of 1,50,000. In that authorized law, you issued 1,35,000 equity shares of rupees 10 each. Inside that only 8 paid up. Total comes to how much? 10,80,000. Fine. And you are having reserves, which is a general reserve. Perfect. And you are also having CRR, capital redemption reserve. And you are also having securities premium, which is collected in cash. And you are also having profit and loss account 3 lakhs. Perfect, sir. Come to the next area. On 1st April 2022, the company had made the final call, meaning thereby they are not converting this bonus call. In other words, they are not converting final call by way of bonus call. They are collecting cash for the final call. Are getting on 1st April 2022, company had made a final call at the rate of 2 rupees each on 1,35,000 equity shares. On 1,35,000 shares, company made final call. On which date? On 1st April 2022. 1,35,000 into 2, which is 2,70,000. Equity share final call account debit to equity share capital, bank account debit to equity share final call. The call money was received on 20th April 2022. Perfect. Thereafter, the company decided to capitalize its reserves by way of bonus. Perfect. At the rate of 1 share for every 4 shares held. Sir, how many shares I am having? 1,35,000. If you are holding 4 shares, I will give you how many shares? 1 share. I will give you 1 share. That is the meaning of the term 4. 1:4. 1 share for every 4 shares. 1,35,000 equivalent 4 into 1. You will get 37,500 if I am not wrong. Go and check. 1,35,000 divided by 4. 1,35,000 divided by 4, which is 33,000, which is 33,500. Perfect. Very good. Yes, sir. 1,35,000 divided by 4, you are getting 33,500. Now tell me, sir, these many bonus shares I am supposed to give to my existing shareholders. Means from the existing reserves and surplus, 33,500 into face value per share, which is 10. 3,35,000 I have to convert from my reserves to the capital. That is known as capitalization of reserves by way of bonus. That is the meaning of the term capitalization of reserves by way of bonus. Are you getting done? Pass the what they are asking. Now tell me, sir, existing number of shares how much? 1,35,000. Yes. And bonus shares how much? Add 33,500. 1,35,000 divided by 4, we are having 33,750. 33,750. 33,750. 33,750 into 10, you required 3,37,500. You required 3,37,500. Are you getting, sir? This is the amount I required. 1,35,000 plus 37,500. 33,750 plus 1,35,000, which comes to 1,68,750. Which comes to 1,68,750 shares. Everyone, 1,68,750 shares. What is this 1,68,750 shares? Existing shares plus bonus shares, but exceeding what? My authorized capital. Now pass necessary resolutions for what? To increase my authorized capital. I hope you are getting the clarity. Perfect. Pass necessary journal entries. On 1st April, in the books of Preet Limited, journal, date, particulars, LF, debit, credit. On which date? On which date? When they are making final call? On 1st April 2022. On 1st April 2022. Entry: equity share, final call account debit, equity share capital. How many shares? 1,35,000 into 2. How much is the amount? 2,70,000. 2,70,000. Being final call made. Being final call made. I hope you are getting the clarity. Next. Next on which date? Next is on 20th April 2022. Entry: bank account to debit to equity share final call. How much? 2,70,000. 2,70,000. Being final call amount collected. Next one. Yes sir, next one sir. Next one is what? Entry for bonus. Yes sir, but make one working note. Make working note number 1. Calculation of number of bonus shares. Calculation of number of bonus shares. Perfect. Existing number of equity shares. How many are there? Existing number of equity shares? 1,35,000. Bonus ratio. What is the bonus ratio? 1 share for every 4 shares held. Bonus shares 1,35,000 divided by 4 into 1, 33,750. 1,35,000 divided by 4, 33,750. Now amount of reserves to be transferred to capital. Amount of reserves to be transferred to capital. How much? 33,750 shares into 10, 3,37,500. 3,37,500. That is the amount of reserves to be transferred to where? Capital. Next. Pass the entries. Entry, sir. At the date they are silent in the question. I don't think they are telling about the date. Thereafter they are telling, okay, don't write the date. Company decided to capitalize his reserves. First preference is what? CRR. How much is required? 3,37,500. First preference is whom? CRR account to debit. How much is your CRR? 60,000. Next. How much is the securities premium? Second preference is towards securities premium. 37,500. That securities premium must be realized in cash. Here also it is realized. For an unlisted company, okay, you can take your own choice. For listed, it should be realized in cash. Securities premium, how much, sir? 37,500. 37,500. Next. Next one. General reserve, use entire 1,80,000. General reserve account debit 1,80,000. You required 3,37,500. How much I required? 3,37,500. In that low 60 minus 37,500 minus 1,80,000. Balance 60 used from where? P&L account. Two, bonus to shareholders account 3,37,500. 3,37,500. Being bonus shares announced. When you are allotting these bonus shares, what is the entry? Bonus to shareholders account debit. Bonus to shareholders account to debit 2. Bonus to shareholders account debit 2. Equity share capital. How much? 3,37,500. 3,37,500 being bonus shares allotted. Perfect. Being bonus shares allotted. Draw one balance sheet. Extract. Balance sheet bracket lo EX TRA CT. Balance sheet lo extract. Equity and liabilities. First one, share holders funds. Inside that shareholders funds, what is the first one? Inside that shareholders funds, first one, share capital. Note number 1. 2, reserves and surplus. Note number 2. And then that's it. Extract only they are asking. Now write note 1 regarding share capital. First write authorized capital. How many shares of preference? How many shares is the preference? 15,000, 12% preference shares of 10 each. 15,000, 12% preference shares of rupees 10 each. How much? 1,50,000. Next one. 1,50,000 existing, and that 1,35,000 is issued. By way of bonus, 33,750 came into the picture. Total how many shares? By way of bonus, 33 came into the picture. 33,750. 1,68,750. 1,68,750. 1,68,750. Equity shares of rupees. Of rupees 10 each or 100 each? 10 each. 10 each. Perfect. How much? 16,87,500. This is the authorized capital. Come to the next one. Issued, subscribed, issued, subscribed, issued and subscribed. How many they are issuing? 12,000, 12% preference shares of 10 each. 12,000, 12% preference shares of rupees 10 each. How much? 1,20,000. Next, 1,68,750 equity shares of rupees 10 each. How much? 16,87,500. 16,87,500. 16,87,500. Add 1,20,000. You will get 18,07,500. How much? 18,07,500. 18,07,500. Right, sir. Out of above equity shares, 33,750 shares were issued for a consideration other than cash by way of bonus. Shares issued by way of bonus. By way of bonus. I hope you are getting the clarity. Come to next one. Notes 2. What is that notes 2? Reserves and surplus. Reserves and surplus. The first one is what? General reserve. Entire 1,80,000 is utilized and you are having 0. Just present general reserve 1,80,000. Entire 1,80,000 is utilized. Hence 0. Next reserve. CRR 60. Entire CRR is utilized. 0. CRR. Entire CRR is utilized. Hence you are having 0. Next one. Securities premium. Entire securities premium utilized. 0. Entire 37,500 utilized. 0. And finally you are having what? P&L account 3 lakhs. P&L account 3 lakhs. How much utilized P&L account 3 lakhs lo? 3 lakhs minus 60 is utilized. How much utilized? 60 is utilized. And the balance left how much? 2,40,000. This 2,40,000 is form part of your reserves and surplus. This is how you are supposed to be solve your problem. I hope you are getting the clarity. What I did, first I raised the final call, equity share final call account debit to equity share capital, and then bank to equity share final call, and then reserves to bonus to shareholders, and then bonus to shareholders account debit to share capital, and your balance sheet and working note 1 for calculation of bonus amount, and then authorized, and then your reserves and surplus. Let's have a view towards presentation of answer. Where is this chapter? Bonus rights. Okay, CRD number 3. Yes, yes. Equity share final call to equity share capital, bank to equity share final call, done. Yes, equity share final call to equity share capital, bank to equity share final call, done. Then reserves, yes. Securities premium done, CRR done, general reserve done, done. Next, done. Yes, see 1,68,750. Refer the note. Wait, I'll see that note. Done. Out of the above, 33 and equity share of 10 is were issued by way of bonus. Done. Reserves and surplus, C nil. You are having 2,40,000. Working note, number of existing is, this is what? Authorized. I hope you are getting the clarity. You have to write this note. It is ensured that the authorized capital after bonus issue should not be less than the issued share capital, including bonus, in all the practical problem. The authorized may be either be increased by an amount of bonus issue by adding shares. So you have to pass the necessary resolutions for that. I hope you are getting the clarity. Yes, sir. Put the heading accounting for bonus shares. Accounting for bonus shares and rights issue. Accounting for bonus shares and rights issue. What is meant by bonus shares means giving bonus shares refers to allotment of free shares to its existing equity shareholders. Bonus shares refers to allotment of free shares to its existing equity shareholders in proportion to paid up share capital, in proportion to paid up share capital. Very good. In proportion to paid up share capital. First one, sir. First one is, I am having reserves and surplus. What I am having? Reserves and surplus. That reserves and surplus I am transferring to capital by way of what? Bonus. By way of bonus. Converting your reserves and surplus. Converting your what, sir? Reserves and surplus. Converting reserves and surplus. Converting reserves and surplus into what? Into capital by way of bonus. By way of bonus. By way of bonus. Very good. Next. Yes, sir. The corresponding section Section 63 talks about issue of bonus shares. Now, whenever bonus shares are issuing, no impact in cash, no impact in cash or bank. Matlab, I am giving it free of cost. Next one, increase in share capital. Increase in share capital or increase in number of shares. Yes, obviously my number of shares will increase. Decrease in market price. Where it is decrease, sir? Decrease in market price. Very good, sir. Next, decrease in earning per share. If you are issuing bonus shares, means there will not have any impact in your cash and bank balance. Increase in number of shares and increase in share capital, decrease in market price and decrease in earning per share, and net worth remains same. Net worth remains same. Net worth remains same. Next. Yes, sir. If company wants to give bonus, means there are certain requirements. First, authorization in AOE is required. Yes. Then there should be an authorization in AOA and there should be one members approval. Members approval should be there. Yes. Members approval should be there by way of authorization. Next, there should not be no default, sir. When you want to give you bonus, means there should not be no default in terms of what? Either principal or interest in terms of what? Fixed deposits or any debt securities or any statutory dues. Also there should not be no default in statutory dues. And bonus shall never be given in lieu of dividend. Bonus shall never be given in lieu of dividend. And once the decision is made, you can't withdraw the decision. Today I have announced the bonus. And once the decision is made, you can't withdraw such decision. Sir, first of all, there should be an authorization. Yes, sir, authorization is there. And there should be, and that board of directors has to be proposed that, and it should be approved by equity shareholders members. Okay. And there should not be no default in principal and interest, and there should not be no default in statutory towards employees. And bonus shall never be given in terms of what? In lieu of dividend. And once the decision is made, you can't withdraw such decision, and any other conditions as may be prescribed. Okay, sir. These are the conditions. Bonus are of two types. One is bonus issue. One is bonus call. If you want to issue bonus, it should be fully paid up shares. It should be fully paid up share. If you want to give bonus issue, the existing equity shares must be existing equity shares must be fully paid up. When existing equity shares are not fully paid up, you can convert partly paid up shares into fully paid up shares by way of bonus. You can convert partly paid up shares into fully paid up share by way of bonus. Next, sir, when you want to issue bonus issue, what? Bonus issue. The reserves what you can use, sources for bonus issue. Sources for bonus issue. Sir, if you are having 1 lakh equity shares, how many shares? 1 lakh equity shares, and which are fully paid up, fully paid up, fully paid up. Now 1 lakh equity shares which are fully paid up. Now 1:2 ratio, that bonus they are announcing, bonus ratio is 1:2. If you are holding 2 shares, 1 share is what? Bonus. If you are holding 2 shares, 1 share is what, sir? Bonus. Now entry. First one, CRR can be used for fully paid bonus. Next one, securities premium if realized in cash. Next one, capital reserve if realized in cash. Next one, general reserve. Next one, P&L. Next one, dividend equalization reserve. These are the sources for bonus issue. What is the sources for bonus issue? Means 1 lakh equity shares were there and the ratio of bonus is 1:2. If you are holding 2 shares, bonus will be 1 share. Means company will allot how many shares? 50,000 shares. Company will allot how many shares, sir? 50,000 shares. Company will allot 50,000 shares. Done. Next. Sources: CRR, securities premium, capital reserve, general reserve, P&L, dividend equalization reserve. Next. Next, sir, you have to issue 50,000 equity shares. Per share is 10 rupees face value. You want 5 lakhs. This 5 lakhs has to be taken from where? No cash is inflow, cash inflow not there. From reserves I am transferring to where? From reserves I am transferring to share capital. From reserves I am transferring to equity share capital. I think I hope you are getting the clarity. From reserves I am transferring to equity share capital. Next one. Next one. Which reserves to use? From reserves I am transferring. Which reserves to use? CRR, capital redemption reserve, securities premium, capital reserve, general reserve, P&L, dividend equalization reserve. Second one, sources for bonus call. What is this bonus call means? Partly paid up shares, partly paid up shares, converting into fully paid up shares. Partly paid up shares were converted into what shares? Fully paid up shares. Partly paid up shares were converted into what, sir? Fully paid up shares. Under which the first one? Which reserve to use? CRR cannot be utilized for bonus call. CRR can be utilized only for the purpose of fully paid bonus shares. That is section 655. Section 55 is talking CRR can be used only for the purpose of fully paid bonus. Next, securities premium. Section 2 is talking securities premium can only be utilized for what, sir? Fully paid bonus. Then what to use? Capital reserve, general reserve, P&L, dividend equalization reserve. These 4 reserves can only be used for bonus call. Means, for example, 1 lakh equity shares were there, 8 rupees paid up. 1 lakh equity shares, 8 rupees paid up. Now, what this 2 rupees? which is yet to be called. Now company is converting this partly paid up share into fully paid up share by way of bonus. How much amount required? 1 lakh shares into 2 rupees, which is 2 lakhs required. That 2 lakhs I has to convert from reserves. What reserves? Don't use CRR, don't use securities premium. When to use CRR, when not to use. If it is a bonus issue for a fully paid up share, I am issuing one bonus share. Use what? CRR and securities premium. No bonus issue, it is a partly paid up share, I am converting into fully paid up share by way of bonus. Don't use CRR and securities premium. Once the share is fully paid up, then I am issuing bonus. For example, in this case, I made it as 10 fully paid up by calling that final call by a bonus. Once it is fully paid up, hence once again you can issue what? Bonus in terms of 1:2 or 1:3, 1:4 depending upon the agreed ratio. I hope you are getting the clarity for this. Yes, now come to the entries point, accounting entries. Accounting entries for bonus. Accounting entry for bonus. Bonus issue, bonus call, bonus issue, then reserves account to debit. Because of my bonus, my existing reserves are decreasing, reserves account to debit to bonus to shareholders account and bonus to shareholders account debit to bonus to shareholders account debit to equity share capital. Bonus to shareholders is a liability. This is on the date of announcement. This is on the date of allotment. On the date of announcement and on the date of allotment. On the date of announcement, what is the entry? Reserves account debit to bonus to shareholders. On the date of allotment, what is the entry? Bonus to shareholders account debit to equity share capital. Next, come to the bonus call. Can anyone tell what are the reserves I can use for bonus issue? Once again, the same old story. What are the reserves I can use? The order is important unless there is any other order which is prescribed in the problem. First one, CRR as per which section? Section 55 subsection 3. Next one, securities premium as per which section? Section 52 subsection 2. Next one, capital reserve which is realized in cash, securities premium which is realized in cash, and P&L, and then general reserve, and then dividend equalization reserve. First use general reserve and then come to the P&L. General reserve, and then P&L. I hope you are getting the clarity. Next one. So these are the reserves account debit to bonus to shareholders, bonus to shareholders account debit to equity share capital. Entry for bonus call. Reserves account to debit to bonus to shareholders. Next, equity share final call or first call, whatever the call may be, to equity share capital. This is the asset what I have debited, equity share final call asset, and this is the liability what I credited. Once I made a bonus call by way of conversion of partly paid up share into fully paid up share, neither this asset is not required, neither that bonus to shareholders liability is not required. On the date of allotment, cancel that bonus to shareholders to equity share final call account. I hope you are getting the clarity. I hope you are getting the clarity. Next. Next one, sir. While you are using reserves, which reserves you are not supposed to use for bonus call? CRR I am not supposed to use, securities premium also I am not supposed to use for bonus call. Right? Right. If it is a listed company, securities premium must be realized in cash if I want to use for bonus issue. If it is an unlisted company, there is no such restriction. If you are an unlisted company, even though securities premium is not realized in cash, you can use for bonus issue. Once again, if it is a listed company, securities premium must be realized in cash if I want to use for what? Bonus issue. Unlisted company, securities premium, even though not realized in cash, you can also use for that bonus issue. I hope you are getting the clarity. Yes. Come to the problems part. Yes, that's it. More than that, nothing is there. This is bonus is nothing but giving free shares to the existing equity shareholders by way of conversion of your reserves into capital. This is also known as capitalization of reserves. Capitalization of reserves, or is also known as scrip issue, SCRIP scrip. Capitalization of reserves and surplus into bonus into capital, or converting your reserves into capital. All these things bonus. Next. Come to the bonus and rights issue questions. We can solve some one or two beautiful questions which are important from exam point of view. Come to CRD 3. Make sure that because of bonus issue, if authorized capital is increasing, then write one note. Okay, wait, I'll tell all these things. Following notes pertaining to whom, sir? Pertaining to the balance sheet of Preet Limited. Okay, the following is the notes which is the following with this balance sheet which is pertaining to the Preet Limited. 15,000 12% preference shares of 10 each, that is 1,50,000. 1,50,000 equity shares of 10 each, that is 15 lakhs. This is what is your authorized capital. 12 lakh, 12,000, 12% preference shares of 10 each fully paid up. Very good. 1,35,000. The difference here is how much? 15,000 is yet to be issued. Very good. Which you paid only 8. 10,80,000. Come to reserves and surplus 1,80,000. Come to CRR 60. Come to securities premium 37,500. Come to profit and loss account 3 lakhs. On 1st April 2022, the company made a final call at the rate of 2 rupees. On 1st April 2022, company made a final call at the rate of 2 rupees each on 1,35,000 equity shares. Very good, sir. On 1st April 2022, company made a final call at the rate of 2 each on 1,35,000 equity shares. Entry, sir. The call money was received by 20th April 2022. So, they are asking you to, okay, fine. First complete the question. So, on 1st April 2022, the company has made a final call to each on 1,35,000 shares. The call money was duly received. Very good. Next. Thereafter, the company decided to capitalize its reserves by way of what? Bonus at the rate of 1 share for every 4 shares held. Okay. What is the problem? There is no bonus call here. Bonus matlab the final call they are raising and they are collecting cash and the ultimate point is they are announced capitalize of reserves by way of bonus at the ratio of 1 share for every 4 shares held. Show necessary journal entries in the books of the company. Prepare extract of balance sheet on 30th April after bonus issue. After bonus issue. Who is this company? Preet Limited. Journal entries in the books of Preet Limited. Extract of balance sheet. Journal entries in the books of Preet Limited. Date, particulars, LF, debit, credit. 1st April 2022. 1st April 2022. Equity share, final call account to debit. 2. Equity share capital being final call made. How many shares? 1,35,000 if I am not wrong. How many shares? 1,35,000 into 2. Yes, 1,35,000 into 2. 1,35,000 into 2. 2,70,000 if I am not wrong. Perfect. And what is the entry for final call received? So the call money was duly received by 20th April. Call money was duly received by 20th April. Entry, bank account to debit. 2. Equity share final call. How much? 2,70,000. 2,70,000 being final call received. Being final call received. Prepare extract of balance sheet. On which date? 30th April. Yes, sir. Prepare the extract of balance sheet on 30th April. Prepare one working note. For what purpose? Prepare one working note for what purpose? Calculation of bonus shares. Calculation of bonus shares. Existing number of equity shares. Existing number of equity shares. How many are there? 1,35,000. Bonus ratio. What is the bonus ratio? 1 share for every 4 shares held. 1:4. Number of bonus shares. Number of bonus shares. That is 1,35,000 divided by 4 into 1. 1,35,000 divided by 4 into 1, 33,750. So, number of bonus shares, how many, sir? 33,750. Next, Next one is amount required. Amount required. How much amount required for from reserves. Amount required from reserves to transfers to capital by way of bonus. How much amount is required from reserves that should be transfers to capital by way of bonus means 33,000, what is this? 750 shares into 10 rupees. I want 3,37,500 in terms of amount that has to taken from the reserves to capital. Now go and check whether that much of reserves is there or not. How much I required? Yes, general reserve 1,80,000 is there. Yes, I am having P and L of 337. Happily I can use. The first preference is CRR, second preference is securities premium, third preference is capital reserve, fourth preference is general reserve, fifth preference is P and L account. CRR how much is there? 60,000. Convert that CRR into capital. Entry. CRR account to debit. How much? 60,000. Next, securities premium. Next, general reserve. How much? Capital reserve is there. If capital reserve is there, use that capital reserve. No capital reserve, right? Yes. General reserve 1,80,000. Total how much? 60, 37,500, 1,80,000, 2,77,500. But I want how much? 3,37,500. Still I required 60. That 60 I can take from where? P and L account. Debit 60,000 to bonus to shareholders account. How much is that bonus to shareholders account? 3,37,500. Next one, bonus to shareholders account debit to share capital. Onward. Bonus to shareholders account debit to share capital account. 3,37,500. 3,37,500. Next one, draw balance sheet. Extract only. Draw balance sheet, extract. Equity and liabilities. First one, shareholder funds. How much? First one, share capital. Second one, reserves and surplus. 1, 2. Yes, that is enough, more than enough. They are asking balance sheet. Yes, extract of balance sheet after bonus issue. Yes. Now share capital lo prepare one notes. Authorized share capital. How much? 15,000, 12% preference shares. 15,000 12% preference shares of rupees 10 each, that is 1,50,000. Next one, 1,50,000 equity shares of 10 each. 1,50,000 equity shares of rupees 10 each, that is 15 lakhs. Next, close this. This is authorized capital. Come to the next one. Issued and subscribed. Issued and subscribed. Now remember one thing, because of bonus your authorized capital increased. Before bonus, what is the number of shares you are having? 1,50,000. How many issued? 1,35,000. How many bonus shares? 33,750,000. Your authorized capital must be 1,35,000 plus 33,750, which is 1,68,750. Don't forget to write 1,68,750. 1,67,000. 1,68,750. Note, you have to mention that after bonus issue your authorized capital is over and above the existing authorized capital. In other words, after bonus issue authorized capital exceeding bonus, after bonus authorized capital is exceeding existing authorized capital. Necessary resolutions OR is passed in the general meeting to increase authorized capital. To increase authorized capital. Issued and subscribed 12,000. Yes, 12,000. 12% preference shares of rupees 10 each. How much? 1,20,000. Next one, 1,68,750 equity shares of rupees 10 each, which is 16,87,500. 1,68,750 equity shares of rupees 10 each, 1,68,000, 16,87,500. Bracket lo out of above 33,750 shares were issued by way of bonus. Were issued by way of bonus. By way of bonus. I hope you are getting the clarity and done. How much this is total? 1,20,000 plus 16,87,500, 18,07,500, 18,07,500. Come to the reserves and surplus. General reserve completely utilized, CRR completely utilized, securities premium completely utilized. From this 3 lakhs lo how much you utilized? From 3 lakhs lo 60 utilized, 2,40,000. General reserve comprising of 2,40,000. That is also nothing but P and L balance. P and L balance not required, only one is there, no. P and L balance. Reserves is nothing but P and L balance to the tune of 2,40,000. That's how you are supposed to solve this question. Sir, what we did? First raised the final call. So equity share final call account debit to equity share capital, received bank account debit to equity share final call. Now there are 1,35,000 equity shares and one bonus share for every 4 shares held, that is 33,750 into 10, which comes to 3,37,500. Right? This is the amount they have taken from CRR, securities premium, general reserve, and balance left in the P and L 2,40,000. Total 3 lakhs. Reduce that and you are having 2,40,000. I hope you are getting the clarity. Just check with the answers. equity share final call, equity share final call to equity share capital, bank to equity share final call, reserves to bonus to shareholders, bonus to shareholders to equity share capital. Done. Done. Yes, that is also completed. Total how much? 1 lakh 20 plus 16 lakh 87,500. Yes, next. Next, you are having 2 lakh 40. Yes, sir, 1 lakh 67,750. That is done. 6 lakh 87,750 done. Done, sir. Perfect. Everything all right. And they have setting that you have completely utilized and nil, and their reserves and surplus they are giving reference to completely nil. Reserves and surplus lo they are giving reference in this number 2 note 2 lo reserves and surplus lo existing general reserve is there 1 lakh 80, that is completely utilized, hence the balance is 0. Next, next one, CRR existing 60,000 is there, entire utilized, like that they are referring. CRR 60 entire utilized, this is also entirely utilized, nil nil nil, and this is 2 lakh 40 which is left, and that is taken from where? Taken to the balance sheet. Come to the next topic, rights issue. Sir, what is this rights issue? What is this rights issue? Section 62, rights issue. Sir, this is also known as further issue of shares. Further issue of shares. In other words, this is known as rights issue. What is this further issue of shares or right shares? Means if you want to issue the further shares, if you want to issue the further shares or you want to issue the right shares, first give that option to the existing, give option to existing equity shares, give such option to the existing equity shares. If existing equity shares are not subscribing, then only issue to the outsiders. Why this, sir? Why this refers to always whenever you are issuing further shares, you will issue at a price less than the market price, less than the market price. Is there any small benefit? The benefit shall be given to whom, sir? That small benefit shall be given to whom? To the existing equity shareholders. To the existing equity shareholders. I'll complete this with a small example. I'll teach with a small example, then you'll have better understanding about what is this rights issue. Yes, sir. Company is giving an option to existing equity shareholders. Whenever company is going for further issue as per section 62, whenever company is going for further issue as per section 62, the offer shall first given to, the offer shall first given to existing equity shareholders. The offer shall first given to existing equity shareholders. Generally, if the market price of a share is 120, means these further shares were issued by the company slightly less than the market price. Slightly less than the market price, issue price will be around 100 or 110, but it should be less than 120. That small gain what is there, reduction of this issue price less than the market price, that gain what is there shall be given to the existing shareholders. That is the main objective of this rights issue. Okay, sir. Now you can have two options. Option number 1, Either you can purchase these right shares, option number 1. Either you can purchase these right shares or you can renounce this right shares. Renounce means giving this right, transferring this right to subscribe the shares to some other party. If I am subscribing the right shares, the market price is 120, the company is offering me at 110. The market price is 120, company is offering me at 110, the face value of these shares were 100. For example, if I, a shareholder who is purchasing shares of this company, the face value is 100 and the issue price is 110, the market price is 120. I am supposed to pass one entry. What is that entry? Bank account to debit company. I am writing entry in the books of company. Bank account debit 110 rupees I am getting per share. 2. Equity share capital 100. 2. Securities premium 10. Where a company offered any shares and allotted these right shares to the existing equity shareholders. That right price, company collected 110, bank capital 100, securities premium 10. This is the entry for what? Issue of shares at a price less than market price. The right shares generally issued at a price less than market price. Solve one question. Pass the necessary journal entries for issue of right shares for the following, assuming that there are shares holders accepting the rights issue. Okay. A company having 70,000 shares of 10 each as its issued share capital and having market value is how much? 21. Market value is 21 and these shares are issued at a price of 10. Now, what is the entry? The company is having how many shares? 70,000 shares. Of 10 each, face value is how much? 10. As its issued share capital and having market value how much? 21. Issuing the right shares at the ratio of 1:10. 1:10 means if you are having 10 shares, company will give you 1 share. Company is having 70,000 shares. If you are having 10 shares, company will give you 1 share, company will allot you 7,000 shares. Entry in the books of company, assuming all shareholders accepted this offer. Number of right shares is equal to existing shares into right ratio, right offer ratio. Existing shares 70,000 and they are telling if you are holding 10 shares, company will give you 1 share. Now the right shares were 10,000 and they are telling all the shareholders is exercise this option. And face value is 10, issue price is 10, market price is 21. I will write an entry in the books of company at issue price, that is at 10 per share. Entry: bank account to debit, how much you are getting? There are how many shareholders? 7,000 shares in the name of right into 10, 70,000 to securities premium account, 70,000, to share capital account, to share that to equity share capital account, 70,000, equity share capital account 70,000, bank account debit to equity share capital account 70,000. You can also pass 2 entries like bank account debit to equity share application and allotment and equity share application account debit to equity share capital. Directly I am writing only 1 entry. Come to the next one. Company having 1 lakh shares. How many shares company is having? 1 lakh shares and of rupees 10 each as its issued share capital. Okay. And having a market value of 46. Issued right shares in the ratio of 1:2, 1:10. The issue price is 31. Company is having 1 lakh shares. Company is having 1 lakh shares. The issue price is 31. Face value is 10. And right ratio is 1:10. Now, how many shares? Right shares? 1 lakh shares into company will give you 1 share if you hold 10 shares, which is 10,000 shares. 10,000 shares into issue price 31. Entry. Bank account to debit 31 lakhs to equity share capital 10 lakhs to securities premium 21 lakhs. Done. Bank account debit equity share capital. This is 10,000 into 31. This is 10,000 into 10. This is 10,000 into 21. I hope you are getting the clarity. Come to the answers. Bank to equity share capital. Bank to equity share capital 70. Yes, number of right shares to be issued is 70,000 divided into 7,000 shares. Very good, at the rate of 70. Next. Bank super. What is this? 31,000. 1 lakh 10,000. 10,000 into 31. Okay, that is 3,10,000. Yes, sir. Next one is rights issue. In other words, further issue of shares. In other words, preemptive right governed under section 62 of Companies Act. What is this rights issue they are telling? Whenever company is going for further issue of shares, that the first offer shall be given to the existing equity shares in the proportion to their paid up share capital. Whenever company is going for further issuance of shares, whenever company is going for further issuance of shares, whenever company is going for further issue of shares, the offer shall be made to the existing equity shares in proportion to the paid up shares. Are you getting, sir? That shares is known as what? Right shares. The right ratio is 1:10 or 1:5, 1:2. What they are telling is, for example, existing 1 lakh shares were there. Company is telling, if the company is giving a rights offer at the ratio of 1:2. One right share if you are holding 2 shares. But when it comes to bonus, that is a free share. But right share is not at free of cost. Right share is a right I am giving whenever I am going for further issuance of shares. First right I am giving to you. Either you want to purchase from the company. If you don't want to purchase, then I will issue in the open market, or then I will issue to the outsiders, or then I will issue to some other guy. The first priority is you. If you want to buy, come and buy here. If you don't want to buy, then only I'll issue to the outsiders or some other guys. Now, company is giving one offer to you. What is that offer? Market price is 20 rupees. How much? 20. Face value is how much? 15 or 10. Face value is 10. Issue price is slightly lesser than market, 18 rupees. You come and purchase here at 18. Sell in the open market at 20. You will get the gain of rupees 2. Are you getting, sir? Everyone. So what they are indirectly telling is, now if you want to purchase the right shares, you can have a gain of rupees 2 rupees here. Are you getting, sir? That 2 rupees gain I am giving to you. Okay, sir, I will purchase these shares. What is the entry, sir? Bank account debit. I am talking in company's point of view. Bank account debit. Imagine 1000 shares were there. Yes, I am giving a right. For every 2 shares, I will give you 1 right. Means divided by 2 into 1, that is 500. Into they are paying me 18 rupees. 500 into they are paying me 18 rupees, which is 9000. Bank account debit 9000. Company point of view, equity share capital 5000 to securities premium 4000. Are you getting, sir? Yes, sir. Entry. Whenever company issues that existing shareholders a right to subscribe for the further shares in the ratio of the proportion paid up share capital, in the proportion of paid up share capital. Now, the issue price will always be less than the existing market price. Now the company need to pass one entry, bank account debit to equity share capital, and if the issue price is over and above the face value, securities premium will come and sit. Example, sir. Company is having 1 lakh shares. Existing shares 1 lakh, equity shares 1 lakh. Now, existing equity shares 1 lakh. Ratio. This is right ratio. 1:2. What the company is telling, if you are holding 2 shares, the company will give you how many shares? 1 share. If you are holding how many shares? 2 shares. Company will give you how many shares? 1 shares. Then number of right shares is equal to, first calculate number of right shares. Existing equity shares 1 lakh divided by, if you are holding 2 shares, company will give you 1 share. Means you will have right shares how many? 50,000 right shares. You will have how many right shares? 50,000 right shares. Now company assuming all the shareholders subscribe for the rights. Assuming all shareholders subscribe for the rights. What is the entry in the books of company? Company allotted how many shares? 5,000, 50,000 shares company allotted. Entry. Bank account to debit. How much you are getting? Bank account to debit. How many shares? 50,000 into what is the issue price? 18 rupees if I am not wrong. Yes, 9 lakhs. Yes. 2. Equity share capital 5 lakhs. How 5 lakhs? 50,000 into 10. To securities premium. How much? 4 lakhs. That's how it works. Bank account debit to equity share capital to securities premium. Then done. This is for what? For issue of right shares. Right shares will always be issued at a price which is less than market price, prevailing market price. We can have one problematic part. Yes, sir. Read this problem. Pass necessary journal entries. Okay, I will pass the necessary journal entries. For rights issue, okay. Now, company having what? Company having 70,000 shares of rupees 10 each. Issued share capital and having market value of how much? 21. Issued rights ratio in the ratio of 1:2 at an issue price of rupees 10. At an issue price of rupees 10. Company is having how many shares? 70,000 shares. Of rupees how much? 10 each. At an issued capital, issued share capital and having market value of 21. Market price is 21. Next. Right ratio 1:10. Face value 10. Very good. Now, what is this? Company is holding how many? 70,000 shares divided by 10 into 1. What is the right ratio? 1:10. If you are holding 10 shares, company will give you 1 share. Total number of shares, company is having 70,000 shares divided by 10 into 1. 7,000 is the right shares which is issued by the company. Very good. What is the market price? 21, but the issue price is 10. Market price is 21, but I am giving a benefit for you in the name of what? Rights. You purchase the share at rupees 10 from the company and sell it in the open market at the prevailing market price, then you will have the gain. As you are the existing shareholder, that gain I am giving to you. Entry. First one. Calculation of number of right shares. Calculation of number of right shares. Calculation of number of right shares. Number of existing equity shares. Number of existing equity shares in our problem was 70,000. Rights issue in the ratio of. Rights issue in the ratio of 1:10. If you are holding 10 shares, the right share you will get a right for 1 share. Next. Number of right shares. 70,000 divided by 10 into 1. 7,000 shares. 7,000 shares. Entry for this. Face value 10. Issue price 10. Market price 21. Entry. Bank account to debit. How many shares? 7,000 shares into 10. How much? 70,000. 2. Equity share capital. How much? 70,000. Being right shares allotted. Being right shares allotted. I hope you are getting the clarity. Everyone, come to the next one. Company having 1 lakh shares of rupees 10 each at its issued share capital. Company, assuming all the shareholders are accepted rights issues. I am writing these entries assuming all the shareholders are accepted the right issues. Company having how many shares? 1 lakh shares of rupees 10 each at its issued capital and having a market value of how much? 46. Issued rights issue at the rate of 1:10. 31 is what? Issue price. What are the facts? Company is having 1 lakh shares and the right ratio is 1:10 and all the shareholders is subscribing for the rights. Means if you are holding 10 shares, company will give you 1 share which is 10,000 shares. Are you getting or not? Yes sir, 10,000 shares. Next, face value 10, market price 46 if I am not wrong, issue price 31, issue price 31. Now tell me the entry. How many number of right issues, right shares? 10,000. All the shareholders are subscribing. Entry. Bank account to debit. How many? 10,000 into 31, 3,10,000 if I am not wrong. 2. Equity share capital account. How much? 1 lakh. 2. Securities premium account. How much? 2,10,000. I hope you are getting the clarity. Are you getting, sir? Go and check with the answers part. First one, bank to equity share capital, done. Next one, bank. How much you are getting? 3,10,000. Then answer is correct only. Bank account debit 3,10,000 to equity share capital how much? 1 lakh to securities premium 2,10,000. Done. Come to the next problem. Sir, for example, 1,000 shares were there. How many shares were there? 1,000 shares were there. And the market price of this 1,000 shares is 20, which is 20,000. Company gave one right offer for you, which is at the rate of 1:2, means 500. And always the right price will be less than the market price, 18 or 16. Are you getting, sir? Now, what is that holdings? 8,000. Now, 28,000, my total holdings divided by 28,000 divided by 1,500, which comes to 18.67. What is this 18.67 is after rights, the price after rights issue. This price I will call it as X right price. What price? X right price. And this 20 rupees I will call it as come right price. And this is known as right issue price. After rights issue, the X right price will be always less than the come right price, as the number of shares are increasing and the right price we are issuing at 16. What is this 28,000 total holdings divided by 1,500? You will get how much? 18.67. Okay, sir. Let's come to one more. Imagine a shareholder holding 1,000 shares, having a cost of 20,000 incurred, and company gave an offer to subscribe rights of 500 shares, but he denied to accept that offer, or he don't know such offer is there. If he is not accepting, company will offer this to an existing equity shareholder or some other guy on some prospective basis. Company will offer these 500 shares to some other guys. Yes, means number of shares also increased and the market price will fall down to 18.67. After rights issue, the price is 18.67. The market price will fall to 18.67. If I want to sell these 1,000 shares in the open market, it will not fetch me 20 rupees per share. It will fetch only 18.67, means I will get only 18,670. Because of this rights issue, company went into losses. Company, not company. This shareholder went into losses. Because of company went for rights issue, as I am not subscribing from this right shares, I will end up with loss of 1330. What company is telling, if you don't want to subscribe these 500 shares, okay, no problem, don't subscribe, or at least sell this right to renounce this right to some idiot. Sell this right to some idiot. How much loss you are getting? 13,000, 1330, 1330. Then divided by how many shares you are having rights? 500. Sell one right for 2.66. This is known as value of right. Are you getting, sir? Sell this for 2.67. Sir, how to compute this value of right, sir? How much you are getting loss? 1330 divided by how many number of shares you are having? 1000 shares. Per share how much you is the loss? 1.33. But how much you are supposed to recover? You are need to recover 2.66 per share on the right shares. Yes, sir. Goodwill adjustment in case of admission. Goodwill adjustment in case of admission. Sir, when a new partner is admitted, whether he is settling that goodwill privately, not bringing within the books. Now, don't account for that. Goodwill amount is settled privately, don't bring within the books. No, sir, goodwill amount is not settled separately. Goodwill amount bought in by new partner in cash. Goodwill amount bought in by new partner in cash. Goodwill amount is not bought by the partner. In other words, if the goodwill amount is brought in cash or it is not brought in cash, means it will be adjusted through capital accounts. Adjusted through capital accounts. If the goodwill amount is privately settled, no accounting treatment, no accounting is required, no accounting treatment. If goodwill is brought in by the new partner, entry 1, cash is coming, cash account to debit. 2, the partner who is giving that cash, new partner or gaining partner, new partner or incoming partner, new partner capital account. Second one. Now this amount what he is bring is that amount is in his name. His capital account it will be credited, but this amount will be belongs to whom? To the sacrificing partners. Now debit to new partner capital account to the tune of goodwill. New partner capital account to the tune of goodwill to sacrificing partners in the sacrificing ratio. To sacrificing partners, maybe 1, 2, 3 depends, sacrificing partners in sacrificing ratio. Sir, can I write one entry? Cash account debit to sacrificing partners in sacrificing ratio? 100% you can write one entry, that is cash account to debit to sacrificing partners in the sacrificing ratio. Are you getting, sir? Next one. Sir, what if already the goodwill is there in the balance sheet? Cancel that goodwill. What is the entry to cancel that goodwill? Old partners capital account in old profit sharing ratio to goodwill. Old partners capital account in the old profit sharing ratio to goodwill. Cancel that goodwill what is already existing in your books of accounts balance sheet. Now, that newly incoming partner bringing his share, it is not firm's goodwill, his share of goodwill in cash. Entry, cash account debit to newly incoming partners capital account, newly incoming partners capital account debit to sacrificing partners capital account. Goodwill amount not withdrawn. Now, goodwill amount not drawn. For example, forget about that case. In this case, there are two options. The amount of goodwill amount is in the name of the sacrificing partners in the sacrificing ratio. They can withdraw that amount. Then entry, partners capital account debit to cash. They can retain as their capital contribution. No entry once again required. If they are withdrawn, partners capital account debit to cash. In some problems, they will tell half of the goodwill amount is withdrawn. Half means out of this his share lo half. His share lo half is withdrawn. Then partners capital account debit to cash account. I hope you are getting clarity. Sir, when goodwill amount is not bought in cash, adjust through capital accounts. Incoming partners capital account debit or gaining partners capital account. Gaining partner or newly incoming partners capital account debit to sacrificing partners in their sacrificing ratio. Calculate firm's goodwill. Calculate firm's goodwill. There are actually two case scenarios, raising and write-off and goodwill account not to be appeared in the books. In the question law, if they are expressly telling that goodwill account not to be raised in the books, then don't bring goodwill into the books. Then directly route 3 capital accounts. Route through capital accounts means what? Gaining partner capital account debit to sacrificing partners capital account in what ratio? In sacrificing ratio. Gaining partners capital account debit is nothing but incoming partners capital account, new partners capital account debit to sacrificing partners in their sacrificing ratio. Don't bring goodwill into the books of accounts. If in the question law they are telling goodwill not to be raised, then directly you are adjust through the capital accounts. What you did, sir, means indirectly we have deducted from the capital amount what he contributed. In that capital loan, we deducted some amount in the form of goodwill, and that is shared to the sacrificing partners in the sacrificing ratio. No, sir. This is the net entry. When the goodwill account is not to be raised and write off, goodwill account is not to be opened. Question is silent. Follow this method. Question they are telling goodwill account is opened and written off. Raise the goodwill. Goodwill account to debit. Firm's goodwill. Raise the firm's goodwill to old partners in old profit sharing ratio. Old profit sharing ratio. Goodwill account debit to old partners in old profit sharing ratio. Now, write off this goodwill, including all partners, continuing partners, all partners. All partners capital account to debit to all partners capital account debit to cancel the goodwill. This shall be made all partners capital account. This includes newly incoming partner in the new profit sharing ratio. Raise the firm's goodwill, write off the firm's goodwill. Raise the firm's goodwill and credit will be given to the old partners in the old profit sharing ratio. Goodwill account debit to A, B, C, old partners profit sharing ratio. If it is some 1 lakh, 2:2:1 means A 40, B 40, C 20. Now, including the incoming partner, all partners in the new profit sharing ratio, write off the firm's goodwill and cancel the goodwill what you have debited. Net impact, then in newly incoming partner account will be debited and old partners will be credited. Net impact will be here 40, 40, 20 will be credited. In the new ratio, if you debit, earlier you credit, now you are debiting, ultimately sacrificing partners will be credited to the share of goodwill. The newly incoming partner, gaining partner will be debited to his share of goodwill. When to follow this method? In the question they are expressly telling what? Goodwill to be raised and write off. Question is silent, then directly follow this. Question is telling goodwill, goodwill account is not to be appeared in the books of accounts. Directly follow the what? Incoming partners capital account or gaining partners capital account debit to sacrificing partners capital account in the sacrificing ratio in the goodwill. Sacrificing partners in the sacrificing ratio, that is incoming partner shares goodwill, not firm. Incoming partner share of goodwill only you are supposed to take. Take the firm's goodwill 1 lakh, in that incoming share 1 by 5. How much? 20,000. For that 20,000, debit the incoming partner's capital account and the sacrificing partner's account shall be credited. I hope you are getting the clarity. Sir, what is this goodwill accounting treatment? There are 3 methods. One is goodwill is separately settled. No accounting treatment. Privately they are dealing this with the goodwill. Now, goodwill amount is brought in cash, goodwill amount is not bringing in cash. If the goodwill amount is bringing in cash, cash account debit to the incoming partner's capital account, debit incoming partner's capital account, credit to the sacrificing partner's capital in the sacrificing ratio. Now, you can also pass one entry. What is that? Cash account debit to sacrificing partner's capital in the sacrificing ratio for that goodwill to the tune of goodwill. If that amount is withdrawn, partner's capital account debit to cash. Half of the amount is withdrawn, half of the amount partner's capital account debit to cash, half whatever what may be. Now that goodwill is not bringing in cash. If the question is not telling goodwill is bringing in cash, means that is there impliedly they are asking you to adjust through capital account. If the question they are not telling goodwill is brought in cash, means impliedly they are asking you to adjust the goodwill in where? In the capital accounts. Now what is the entry? Incoming partners capital account debit to sacrificing partners in the sacrificing ratio. Incoming partners capital account debit to sacrificing partners in the sacrificing ratio. That is individual, that incoming partners share alone we have to do. That share of goodwill of the incoming partners, whatever amount is coming, that for that amount only pass the goodwill entry. Entry for that, sir. Entry for that. Yeah. Incoming partners capital account to his share alone, not from his share, to sacrificing partners capital in the sacrificing ratio. Now, goodwill account to be raised and write off. Then firm's goodwill need to be raised and write off the firm's goodwill. When you are raising goodwill account, credit the old partner's capital account in the old profit sharing ratio to the tune of firm's goodwill. When it comes to write off, all partners including new incoming partner to cancel your goodwill. This is the accounting treatment for goodwill. If the goodwill is already appeared in the books, either any of the method, either this or this. If he is bringing goodwill in cash, he is not bringing goodwill in cash. Any method, if the goodwill already appeared in the books, then cancel that goodwill by transferring to the old partners in the old profit sharing ratio. Accounting standard 26 is telling self-generated goodwill will not be recorded in the books of accounts. That is the reason we are not showing that goodwill. Self-generated goodwill shall not be recorded in the books of accounts. Purchased goodwill alone will be shown in the books of accounts. Now, in the problem law, whatever the goodwill they are giving, purchased goodwill or self-generated goodwill, do what? Cancel to the old partner's capital account in the old profit sharing ratio. Do the accounting treatment accordingly. Next important area is partnership. Admission of a partner. Admission of a partner. Sir, I want to admit one partner. A, B, C were existing partners. They want to admit C as a partner. Now, what and all the accounting adjustments you are supposed to make? Before, A and B were sharing profits and losses in the ratio of 1:1, or A and B are sharing profits in the ratio of 3:2 earlier. C is coming and taking 1/4 of the share in the partnership. She is coming and taking 1/4 in the share of the profits. The total profits of the firm be 1. In that 1 law, I am giving C's part 1/4. The balance left is how much? 3/4. That 3/4 I am sharing in the ratio of 1:1. 1/2, and same way that 3 by 4 I am sharing in the ratio of 1:2, which comes to 3 by 8, which comes to 3 by 8, and that guys 2 by 8. If it is 1 by 4, 2 into by 2, if you multiply, it will get 2 by 8. Then the new profit sharing ratio is 3:3:2. Are you getting, sir? No, sir. A and B were sharing their profits and losses in the ratio of 3:2. The total profits of the firm be 1. That is my assumption. Minus how much I am giving to incoming partner? 1 by 4. What is the balance left? 3 by 4. Give this 3 by 4 share in the old profit sharing ratio. 3 by 5. Share this 3 by 4 in the ratio of 2 by 5, which comes to 9 by 20, which comes to 6 by 20. Now, if you multiply 5 by 5, in other words 5 by 5, 5 by 20. Now, the new profit sharing ratio 9:6:5. The first step is to be calculate the new profit sharing ratio. Earlier, the profit sharing ratio, you will have 1:2, 3:2, and they will tell the C is admitted for this much of share, total profit of the firm B1, reduce his share, and the balance is what? Is the new profit sharing ratio. Sir, why you need to calculate new profit sharing ratio? Sometimes in the problem, they only tell new profit sharing ratio. Why you need to calculate this? If they are not giving the new profit sharing ratio, calculate and tell the new profit sharing ratio. They are only giving new profit sharing ratio means my main intention is to calculate sacrificing ratio. Sacrificing ratio is, sir, old law I am getting 1 by 2. 1 by 2. New ratio I am getting 1 by 4. Did I gain or did I sacrifice it for the incoming partner? I sacrificed it for the incoming partner. How you know? Earlier it is more. After the admission of the new partner, it is reduced. Now, if I want to express in form of one formula, old ratio minus new ratio. Old ratio minus new ratio is what, sir? Sacrificing ratio. Old ratio minus new ratio is equal to what, sir? Sacrificing ratio. Sir, what I want to do with this sacrificing ratio? Wait, sir. Step 1 is to calculate sacrificing ratio. Yes, sir, I calculated the sacrificing ratio. Step 2. Calculate the value of goodwill, in other words, goodwill adjustment. Goodwill adjustment. Calculate the value of goodwill, and that goodwill need to be adjusted in what ratio? That shall be given to the sacrificing partner. Gaining partner have to be bring that goodwill, and it shall be given to whom, sir? To the sacrificing partners. In what ratio? In sacrificing ratio. In what ratio? Sacrificing ratio. The goodwill which is brought in by the incoming partner is 10,000. Now this 10,000 need to be shared in the which ratio? Old profit sharing ratio? No, it should be shared in the sacrificing ratio. The goodwill brought in by the incoming partner or the goodwill adjustment what I am doing, that shall be done in what ratio, sir? In sacrificing ratio. To which partner? To his sacrificing partner. Very good. Wait, I'll show in problems also how this goodwill adjustment will have an impact. Third one. Third one, revaluation. Sir, what is this revaluation, sir? Revalue your assets, revalue your liabilities. If you are not revaluing your assets, if you are not revaluing your liabilities, then the incoming partner will have a financial effect on his capital balance. So, don't give any favorable, don't give any benefit, or don't make him loss. So, better do what, sir? Do revaluation our your assets. Revalue your assets, revalue your liability. If asset value is increasing, entry, asset account debit to revaluation, bring to the credit side by asset. If asset value decreasing, to asset. If liability is increasing, then comparing to the book value, now revaluation to liability, to increase in liability. If liability is decreasing, entry in books it is 1 lakh, but it is not 1 lakh, worth only 80,000. Now what is the entry? Revaluation. Liability is decreasing. Now liability account debit to revaluation. Liability account debit to revaluation by liability. Now credit side is more, debit side is less. That is the income, that is the profit will be transferred to, the profit on the realization of assets and liabilities will be transferred to old partners in old profit sharing ratio. Old partners in old profit sharing ratio. I hope you get the clarity. It will be transferred to the old partners in old profit sharing ratio. Come to the working note number 4. Transfer of accumulated profits and reserves to the partner's capital account. Transfer of accumulated profits and reserves to where, sir? To partner's capital account. What is this you are talking? No. In your balance sheet, you are having reserves and surplus. In this reserves and surplus law, you are having journal reserve, you are having all these reserves. Accumulated balance in P&L account, you are having dividend, what is that reserve? A workman compensation fund, all these reserves were there. Now in that workman compensation fund, for example, if entire amount is not required, transfers to the, some 2,000 is required, 3,000 is required. For example, workman compensation fund 10,000 is there. In the current period, you required only 3,000. Balance 7,000 transfers to whom? All partners in the old profit sharing ratio. The accumulated balance in the what? Balance sheet before admission will be transfers to old partners in the old profit sharing ratio because it is their reserves. Are you getting, sir? Next. Working note number 5, adjustment of capital accounts. Adjustment of capital accounts. What is this adjustment of capital accounts, sir? Sir, A's capital is having 2 lakhs, B's capital is having 3 lakhs, C's capital is having 1 lakh, 1 lakh 50. The ratio of profit sharing ratio is 2:1. 2:1. Make capital balances in proportion to A's capital balance. If they are telling, means what is that meaning? For 1 share, how much he is bringing? 1 lakh 50. For 2 shares, how much should B's capital? 3 lakhs. Now his capital is okay. But for 2 shares, how much should be C's capital? 3 lakhs. Now bring 1 lakh. Bring 1 lakh. The total capital should be in proportion to the capital employed. If they are telling, the total capital should be in proportion to the profit sharing ratio. Now total capital how much, sir? This is a separate case, this is a separate case. They are telling one partner as a base, and if they are adjusting, means that is the adjustment. They are telling total capital should be in proportion to profit sharing ratio, means total capital how much? 6 lakh 50 divided by 5 into 1. How much should be the A's capital? 6 lakh 50 divided by 5 into 1, 1 lakh 30. This is what? This is C's capital should be. Now, how much should be the B's capital? 2 lakh 60. How much should be the C's A's capital? 2 lakh 60. Bring 60,000. Who? A. A should be how much, sir? 60. Now, give that 40,000 to whom? B. 20,000 to whom? C. The total capital of the firm must be in proportion to the profit sharing ratio, means after revaluation, after goodwill adjustment, after everything, transferring your reserves and everything, get your capital balance. This should be the total capital divided by PSR, profit sharing ratio. Then you will get each partner should have how much, any excess capital withdraw, any lower capital balance is lesser than the actual capital should be, then brought down that capital. Are you getting? No, sir. This time they are telling the total capital should be in proportion to the incoming partner, means his capital is 1,50,000 for one share. For two shares it shall be 3 lakhs. He is okay 3 lakhs. A shall bring 1 lakh. This is how you are supposed to make your capital adjustments. Are you getting? So what is there in this admission of partner, means a new partner is admitted. First one, calculate what, sir? Sacrificing ratio. Second one, goodwill adjustment. I already covered how to cover the goodwill adjustment. When it is there privately settled, don't bring that into the books of accounts. When he is bringing his share of goodwill into the cash, you are having two methods. One, bring that cash and directly give to whom? Partner's capital account, or bring goodwill, cash account debit to goodwill, goodwill account debit to whatever you want to do. Second one, sir. The partners, third method. Step 3 is revalue your assets and liability. Step 1, sacrificing ratio. Step 2, goodwill treatment. Sir, I already covered this goodwill treatment, sir. I hope you got the clarity. Step 3, revalue your asset and transfer the surplus profit or loss to the capital accounts. Step 4, transfer accumulated profits to the partner's capital account in the old profit sharing ratio. Step 5, capital adjustment. Capital adjustments. I hope you got the clarity. Yes, sir. There is one more which is known as memorandum revaluation account, sir. What is this memorandum revaluation account? It is mirror image of revaluation account. So the partners are decided not to revalue the assets, but they want to give the effect of this revaluation in their capital accounts. Whatever debited, decrease in the value of assets, yes sir, decrease in the value of assets debited. Next, decrease in the value of liabilities credited. Now, you are having credit side is more, debit side is less, it will be taken to whom, sir? Old partners in the old profit sharing ratio. Old partners in the old profit sharing ratio. Up to this, okay? Yes. This is what, sir? Decrease in assets. This is what, sir? Increase in assets. This is what, sir? Increase in liability. Increase in liability. This is what, sir? Decrease in liability. Okay. I recorded that increase in assets and decrease in assets, everything. Now the balance will be transferred to what, sir? To the old partners, to the old partners in the old profit sharing ratio. So now mirror image, same figures, throw it on the credit side. Same figures, don't change anything, throw it on the debit side. Now the net impact will be given to the all partners including the incoming partner in the new profit sharing ratio. This is known as this memorandum revaluation account. Sir, they don't want to change the value of assets and liabilities. Though they don't want to increase or decrease the value of assets and liabilities, but they want to give with this the effect in the capital accounts. The assets are to be revalued as like this, the liabilities they will give, but the partner decided not to revalue the assets and liabilities, but the effect should be given in the capital accounts. That is the way. Vice versa also can be done. You might got revaluation loss. If it is coming this side, now share that to the old partners. Immediately opposite side, give it this to whom, sir? To all partners A, B, C, D. To all partners A, B, C, D. I hope you got the clarity. Yes, sir. Now start with one problem, sir. admission, go through the problem. There are three partners A, B, C. Yes, sir, there are three partners A, B, C. You are having assets, cash, debtor, stock, furniture, building, bills receivable. Similarly, you are having liabilities, bills payable, liabilities creditor, you are having capital accounts A, capital account B, capital account C. They agreed to take D into partnership and give him 1/4 share in the profits on the following terms. Yes, sir. That first one. What is the first step, sir? In our all the problems, same, follow the same way. Step 1. Calculation of what, sir? Sacrificing ratio. Now, what is the formula for sacrificing ratio? Old ratio minus new ratio. What, sir? Old ratio minus new ratio. What is the old ratio? 1:1:1. What is the new ratio? I don't think they have gave you new ratio. Then calculate the new ratio. So, how to calculate new ratio, sir? 1 minus 1/4. They agreed that to take D into partnership and give him a 1/4 share in profits. 1 minus 1/4. This 3/4 they will share in the ratio of 1:1:1 means 1/3. 3/4 into 1/3. 3/4 into 1/3. How much then? 3/12. 3/12. 3/12. Make it as 1/4 into, if you multiply with, it also comes as what? 3/12 into 3/3. Means all partners are now, new profit sharing ratio is also 1:1:1:1. Are you getting, sir? Now you are having new profit sharing ratio. Now you are also having old profit sharing ratio. Old minus new. What is the old ratio? 1/3. What is the new ratio? 1/4. This is what? Your sacrificing ratio. Are you getting, sir? Yes, sir. Check the answer. Yes, sir. Step 1, calculation of what? Sacrificing ratio. What is the first step? Working note number 1. Step number 1, you are supposed to calculate what, sir? Your sacrificing ratio. Tell the sacrificing ratio. Completed? Yes, sir. Old ratio is nothing but your sacrificing ratio. So, what is that old ratio? 1:1:1 is your sacrificing ratio. Done. Step 1 is done. Come to the step 2. What is the step 2, sir? Goodwill. What they are telling about goodwill? C should bring goodwill how much, sir? 6,000. So, if the D should bring goodwill of 6,000, that 6,000 goodwill should be shared by who, sir? The 6,000 goodwill will be shared between whom? Shared between the sacrificing partners in what ratio? Sacrificing ratio. All the three partners are the sacrificing ratio. Now, this goodwill need to be shared in what ratio? 1:1:1. Each partner will get how much? 2,000, 2,000, 2,000. Right? Right. Now, next one. So, 1/2 of the goodwill should be withdrawn. Matlab 1/2 refers to how much, sir? 1,000, 1,000, 1,000 they are withdrawing entry. So, when that goodwill you are supposed to be credit, what is the entry, sir? Cash is coming in, cash account debit to all the sacrificing partners capital account. Cash account debit to sacrificing partners capital account in what ratio? in sacrificing ratio. So cash account debit A, B, C. When they are withdrawing half amount, then A's capital account, B's capital account, C's capital account debit to cash. Right? Right. So better do one thing. Start writing entries. So working note number 1 is for what? Working note number 1 is for what? Working note 1 is to calculate your sacrificing ratio. Working note 2 is for what? Goodwill. So goodwill calculation is not required. Directly they have provided in your answer. In your main question only they said 6,000 is the goodwill. Don't do anything. Next. What is your working note 3? Prepare revaluation account. Yes sir, and they are only telling to prepare what? Revaluation account. So in the main answer, what is the main answer? They are asking you to pass necessary journal entries and they are asking you to prepare revaluation account. So necessary journal entries the first journal entry, this working note number 1, working note number 2 is what? Your revaluation account. So they are only asking main answer revaluation account. So working note 2, that goodwill is not required, 3 is not required, working note number 4, accumulate not required, so capital also not required. So that half page working note, that leave that page for working note, come to the entries. Next page right, start with the entries sir. They are asking journal entries, necessary entries to give effect of the above arrangement. First one, you are getting cash entry, cash account to debit, cash account to debit to D's capital account, cash account to debit to D's capital account. How much? 16,000. How much? 16,000. So leave entries for that page. Come to the next page. Open revaluation account. Half page revaluation account. Half page. Immediately open partners capital account. Immediately open what sir? Partners capital account. Immediately open partners capital account. Better this partners capital account, make it into a balance working note. That after sacrificing ratio is there, no, I said to leave that page. In that page, maintain capital accounts, open capital accounts, working note number 2. Immediately after revaluation account, open balance sheet. Are you getting in what way you are supposed to open your solution? First working note is to calculate sacrificing ratio. Second working note is to have that partners capital account. Main answer, come to the main answer, pass necessary journal entries means journal entries in the books of what is this firm? Okay, journal entries in the books of so and so firm. Leave that page, full page. Come to the next page. Revaluation account. Half page for revaluation. Come to the next half page. Put the heading balance sheet. That is the requirement. Step 1, step 2, step 3. That you have to follow those steps. You have to follow those steps and you have to start doing the answer. You have to follow those steps and you have to start doing your answer. First entry. Cash account to debit to D's capital. How much? 6 lakhs. So 6,000 plus 10 total 16,000. Cash account to debit to D's capital. How much? 16,000. Sir, in your answer in your journal entries cash account debit to C's capital. I mean D's capital. Now do one thing, sir. In the capital accounts write by balance brought down 20,000. By balance brought down B's capital 15. By balance capital brought down C's capital 10. Are you getting what I am telling, sir? In your working note maintain one working note for capital accounts. In that capital accounts you know how to maintain a capital account. A's capital, B, C. In that by balance brought down, I think what is the opening? 20, 15, 10. Super. Up to this okay. Next come. Immediately open one more working note cash account, sir. Open one more working note cash account. This cash account opening is required for every problem. Not only for this problem. Open cash account is important for every problem. You are supposed to do opening of this cash account for every problem. Open cash account. What is the balance brought down in the cash? 1,000. To balance brought down how much? 1,000. Immediately go to your cash account, write to D's capital, how much? 16,000, right? To D's capital in where? Cash account low, 16,000. Immediately come to the capital accounts, D capital low, write buy cash, 16,000, right? Buy cash, 16,000. Done? Sir, you might ask what I am doing. Sir, first step I ask you to have working notes. Okay. First working note is for what? Calculation of sacrificing ratio. Second working note I ask you to for what? Goodwill calculation. But in this problem, no, they are only telling what is the value of goodwill, not required that working note. Come to the working note 3. In our problems, I ask you to prepare revaluation account, but in this problem, they are only asking as a main answer. Working note, it is not required. Working note number 4, transfer of accumulated balances. That is also not there. Any complexity here, it is not there. So they are asking you to prepare capital accounts. So they are asking working note number 5 is capital accounts. Now, capital accounts. One more working note is cash account. This is uniformly that is there for cash account for all the problems. These are the working notes. Come to the main answer. Journal in the books of so and so, leave one full page for that journal. Come to the next page, open revaluation, leave half or more than half for revaluation account and maintain balance sheet, open balance sheet. Right? Space adequate matlab for one full page for entries, more than a page for your revaluation, and then one more page for what? Balance sheet. Right? First one what they are telling? D's capital how much? Cash account debit to capital. Immediately come to the cash account and write to balance brought down, and immediately come to the capital accounts and write by balance brought down in the respective capital accounts. Now cash account debit to capital, pass the entry, cash account debit to capital. Post in the cash account low 2 D's capital low by cash 16. Done. Done. Next. That one half of the goodwill should be withdrawn by old partners. Come to the working note number 2 low. I said goodwill, they have said low 6,000. Now what is the entry for that goodwill? Yes. Entry for that goodwill is, I am not maintaining opening a goodwill account. I am routing through capital accounts. C's capital, who is the D's capital account? Incoming partners capital account to debit. How much? Goodwill is 6,000. 2. Sacrificing partners A, B, C. Write this entry. Second entry. D's capital account to debit 6,000 to A, B, C 2,000, 2,000, 2,000. D's capital account debit to A's capital, B's capital, C's capital. This is the entry for goodwill entry, adjustment of your goodwill. Come to the capital accounts. A's capital account lo write by D's. B's capital account lo write how much? 2,000. C's capital account lo write 2,000. Come to the D's capital account lo 2A 2,000, 2B 2,000, 2C 2,000 in D capital low, D capital low, D low, debit side, debit side, debit side. Entry sir, D's capital account debit to 6,000 to A's capital, to B's capital, to C's capital. D's capital account debit to A's capital, B's capital, C's capital. D capital low, to A debit side 2,000, to B debit side 2,000, to C debit side 2,000. Credit side of A's capital low by D's capital. A 2,000, B 2,000, 3 2,000. I hope this is done. Yes. So posting is done in the capital accounts. Third entry, sir. What they are telling? One half of the amount is withdrawn. One half of the goodwill should be withdrawn by old partners. What is the entry? A's capital account 1,000, B's capital account 1,000, C's capital account 1,000 to cash. How much? 3,000. Come to your cash account, write by A's capital, by B's capital, by C's capital 1,000, 1,000, 1,000. By A's capital, by B's capital, by C's capital 1,000, 1,000, 1,000. Come to the capital accounts. Capital accounts. To cash. To cash, debit side. A 1000, B 1000, C 1000. I hope you got the clarity. Entry: A's capital account, B's capital account, C's capital account debit to cash. Cash flow by A, by B, by C 1000, 1000, 1000. Capital account lo 2 cash, A 1000, B 1000, C 1000. Next. You are having memorandum, I think memorandum account, in other words revaluation account, that the value of liabilities and assets other than cash shall not be altered. They are asking you to prepare memorandum revaluation account. Okay, I will prepare that memorandum revaluation account. Open that revaluation account. This revaluation account have no balance. Already I said to open in the next page, right? Go to that page. That stock and furniture be depreciated by 10%. Now entry: revaluation account to debit to stock to furniture. Revaluation account debit to stock, revaluation account debit to furniture. One entry is enough. Revaluation account debit. Come to the entry and write revaluation account to debit to stock and furniture. How much is stock? 1200. How much is furniture? 500. Revaluation account debit 1700 to stock 1200 to furniture 500. I hope you got the clarity for this. Immediately come to the revaluation account and write to stock, write to furniture. Write to stock, write to furniture. I hope you got this completed. Next one. That a liability of 1300 be created against bills discounted. That a liability shall be created. Yes, sir. What is the entry? Yes, you are supposed to create one liability for bills. Revaluation account debit to liability for bills. How much? 1300. Write the entry. Revaluation account to debit for liability against bills. How much? 1300. Come to revaluation and write to outstanding liability. How much? 1300. Next one. That the building be valued at 40. What is the building value? 25. If the building book value is 25, 15,000 is the revaluation, upward revaluation. It is again entry. Building account debit to revaluation. Pass that entry. Building account debit to revaluation. Come to revaluation and write by building. How much? 15,000. Come to revaluation and write by building. How much? 15,000. Now calculate revaluation lo. Credit side lo by building 15,000. Debit side lo to stock to furniture. How much? To stock it is 1200. To furniture 500. Means 1700, and liability means 3000 on the total of debit side of revaluation. 3000. 15,000 is credit side total. Difference transfers to 3 old partners A, B, C in old profit sharing ratio. 4,000, 4,000, 4,000. Close that account. Credit side total 15,000, debit side total comes to 3,000. Total 15,000 balance transfers to where, sir? Capital accounts A, B, C. 4, 4, 4. Come to the credit side. Whatever you have posted on the debit side, close that account and come to the credit side and oppositely post. Opposite side lo post. Whatever you post on the credit side, post on the opposite debit side. Opposite debit side. Now this time, debit side is 15,000, credit side is 3,000, 4,000 transfers to the 12,000 transfers to all the partners A, B, C, D. 1:1:1:1. 3,000, 3,000, 3,000, 3,000. Close the revaluation account. Are you getting what I am telling? Immediately come to the capital accounts. On the credit side low, right, by revaluation 4,000 to A, 4,000 to B, 4,000 to C. 4,000 to A, 4,000 to B, 4,000 to C. Come to the debit side of revaluation. To revaluation 3,000 to A, 3,000 to B, debit side 3,000 to C, 3,000 to D. Ultimately, for those three partners, 1,000 is credited. For the newly incoming partner, 3,000 is debited. That is what the whole story about this memorandum revaluation. Close that memorandum revaluation. Close that memorandum revaluation. Pass the two entries, these two entries. First entry is what? Revaluation to ABC, 12,000 debit, 444. Second one, A's capital, B's capital, C's capital, D's capital, 3,3,3,3 revaluation. Done. Entries relating to revaluation is done. Right? There is no impact in the cash also. Yes, problem done, sir. Completed. Yes. Now, open balance sheet. Balance sheet lo cash balance in your cash account lo close your cash account and tell what is the closing cash balance. You are having 1,000. Yes. 16,000 is brought by whom? Incoming partner. Total 17,000. 3,000 is taken by whom? Partners. 17 minus 3. 14,000 is what? Is your closing cash. 14,000 is your closing cash. They are not asking that don't change debtor values. Okay, show your debtor at what? 10,000. Stock 12,000. Furniture 5,000. Building 25. Bills receivable 1,000. I hope you are getting the clarity. Yes, sir. Next. Bills payable. How much? 3,000. Creditor. How much? 3,000. Now come to the capital accounts. Come to the capital accounts. Completed closing your capital accounts. Tell the balance. A's capital account lo balance how much, sir? 22,000. Yes. To balance carried down A's capital account lo 22,000. B's capital account lo 17,000. B's capital account 17,000. C's capital account lo 12,000. D's capital account lo 7,000. Go and check if you are getting same answers. Throw that into the balance sheet liability side. Your balance sheet will get tallied. Are you getting? I hope you got the clarity over this problem. Nothing is there, sir. Yes. Capital account lo by balance brought down. By balance brought down 20,000, 15, 10. Yes, immediately by D's capital. For each partner 2,000, 2,000, 2,000 is credited. For that D 16 is credited. Now debited with 1,000, 1,000, 1,000. Now credited with 4,000, debited with 3,000. That debit of 3,000 is done to the newly incoming partner alone. I think that is only your capital accounts. Yes. Yes, your balance sheet will get tally. Go and check. Yes, cash to capital. Yes, this is also done. Yes, this entry is also done. Posting is also done. Building to memorandum revaluation. Yes, done. That account what you have prepared is memorandum revaluation account. Done. This is also done. This is also done. This is also done. This is also done. We passed this entry and we also passed this entry. Yes, they are asking you to prepare. I already clearly explained this. I clearly explained. Open capital accounts. I think they didn't open capital accounts, just open capital accounts. And I said, this is also everything, sir, everything I said. Then they're asking you to find a cash balance. I said 14,000. Done? Yes, sir. Important from exam point of view. Similar models they will ask in the exam. Come to one more problem, sir, in the admission law. So, Dalal, Banerjee, Malik were partners in the firm sharing profits and losses in the ratio of 2:2:1. Their balance sheet as on 31st March 2020 as on follows. They are providing with land and building, furniture, inventory, sundry trade receivables, cash in hand, cash at bank. Yes, outstanding liabilities, general reserve and all these things. Yes, sir. What is the first step, sir? The partners have agreed to take Misri as a partner with effect from 1st April 2022 on the following terms. Yes, sir. Misri shall bring 5,000 towards his capital. They are asking entries, sir. They are not asking entries, not required to pass entries, sir. So, prepare revaluation account, open revaluation account, capital accounts and balance sheet. Revaluation, capital and balance sheet. Now come to working note 1. First one revaluation, second one capital accounts, third one balance sheet. Main answer done. Come to working note number 1 after balance sheet, half page working note number 1. What is the calculation of what ratio? Sacrificing ratio. They are only giving new ratio 1:1:5:5:3:2, 5:5:3:2. That is the new ratio. I think you are also having old ratio 2:2:1. Calculate the sacrifice ratio, working note number 1. Open capital accounts. Take the balances by balance brought down, by balance brought down, by balance brought down capital accounts. Working note lo open cash account. Working note lo open cash account. Yeah. Entry, sir. Cash account debit to Mistry capital account, but you are not writing, you are supposed to pass the entry. Write in the Mistry's capital account lo by cash. How much? 5,000. Value of inventory should be increased by 2,500. Revaluation account lo actual entry, inventory to revaluation, revaluation lo by inventory 2,500. Furniture should be depreciated by 10%. What is the value of furniture? 650. Revaluation lo to depreciation on furniture 650. To furniture 650. Reserve for doubtful debts to be maintained at the rate of 10% on sundry debtors. 5,500. 10% comes to 550. Now, revaluation account debit to provision for bad and doubtful debts 550. Land and building should be enhanced by 20%, means 5,000. Entry, land and building to revaluation. Revaluation lo by land and building, how much? 5,000. They are only giving firm's goodwill at 15,000. How much is the firm's goodwill? 15,000. The value of goodwill fixed at 15,000. Now, to the incoming partners, what is the share? 2/15 comes to 2,000 if I am not wrong. Yes. Passed for that 2,000 in what ratio? Who are all the sacrificing partners? To the sacrificing partners in the sacrificing ratio. Give that goodwill of 2,000. Yes, even they are not telling us, I will transfer general reserves to where? To partners capital account. Nothing is there in the problem. Transfers to general reserve to old partners in the old profit sharing ratio. By general reserve. 6,500 divided by 5 into 2, 5 into 2, 5 into 2. Next. The outstanding liability includes 1,000 due to Mr. Sen. Paid by Dalal. So, Sen account to debit to Dalal capital account. Sen account means Sen is not there, it is there in the trade payables. Yes. Outstanding liabilities, it is there in outstanding liabilities entry. Outstanding liabilities account debit to Dalal's capital account. Outstanding liabilities account debit to Dalal's capital account. Dalal's capital account lo write by outstanding liabilities. How much? 1000. By. You are asking necessary entries, right? So you are supposed to write the entries also. You are supposed to write the entries for all these steps. Any thing is there, new thing which what we have not discussed? First one entry, cash account debit to, who is that new? Malik's capital account. Second one, the value of inventory should be increased. So inventory account debit to revaluation. Furniture should be depreciated. Entry, depreciation, I mean revaluation account debit to furniture account. Reserve for bad and doubtful debts. What is the entry? Revaluation to reserve for bad and doubtful debts. Value of building should be increased. Entry, land and building account debit to revaluation. Value of goodwill, I said goodwill treatment. General reserve, so partners capital account debit to general reserves. Then outstanding liability entry also I said. So cash and bank low. How much you will have? 5,000 is only the capital contributed. They are not telling goodwill is brought. If they are not telling goodwill is brought in by the new partner, if goodwill is not brought in by the new partner, it is to be adjusted in the capital accounts. Yes, the 2,000 need to be adjusted in the capital account. Incoming partner account debit, partners capital account debit 2,000 to old partners in the sacrificing ratio. Cash balance how much? 1100 plus 5,000. 6,100 is the balance of cash. Yes. Transfer, this is 6,000. Gain. I hope you get the clarity on this. Transfers to the old partner's capital account. Come to the partner's capital account, balance brought down. This is general reserve balance. This, and in the sacrificing ratio, revaluation, profit, outstanding liabilities is taking, and goodwill adjustment. Right? Closing capitals. Bring this closing capitals to the balance sheet. Cash balance is how much? Yes, I said no. Supposed to reduce that provision. Add that revalued figures. It is not like previous problem. Everything I said. It is not like previous problem. I hope you got the clarity on this admission. Simple problems. If they are asking capital adjustments, I said how to adjust capital. I said right how to adjust the capitals accordingly. If it is on the based on the newly incoming partners capital base, then for this much of share, this much, for others how much, or the total capital should be in accordance with the profit sharing ratio. Then the total capital should be bring into the newly profit sharing ratio. Then some partners might withdraw or some partners might require to contribute, do accordingly what is the specifications of the problem. Yes sir, let's come with admission is over. So in the partnership law, reconstitution, what sir? Reconstitution already I covered. First one is what? Admission. Second one retirement. Third one death. Fourth one dissolution. And change in profit sharing ratio. Change in PSR. Remove the dissolution. For change in PSR, for admission, for retirement, for death, all these four segments, the treatment almost same. The steps what we follow almost same. In case of an admission, the incoming partner brings his cash along with goodwill. In case of retirement and death, in case of retirement, the retiring partner taking his capital share along with his share of goodwill in the partnership. Next, in case of a death, the deceased partner will take his share of money along with what? along with that his share of goodwill. The main difference between admission, retirement, death. Admission lo, if a partner want to admit, I will stop him, wait for the next 3 months, 4 months, 5 months, year will get over, we can prepare final accounts, we can know our profit and we can share into this PSR, then we will take you as a partner. Until that point of time, you can come and you can work here, you can see how these functions are running, but you will not get any share in the profits. Why? Because I don't want to disturb my accounts in the middle of the year. Retirement also almost same. At the end of the period, he will retire, and I also tell even in the middle, there is no chance. If you are going out in the middle, our books will get disturbed in respect of how much profit I need to share in the current year from the date in which current period started to the date of retirement. Death, I can't tell to the deceased partner, hey partner, don't die today, wait for 4 months, books of accounts will get closed, then you die. Books of accounts you can easily, I can share the profit. We can't tell to the deceased partner, right? Right. Now, the problem comes in between retirement and death. In case of retirement, I can make it as on 31st March as 31st December. So that I can compute the profit up to the date, and that profit can be distributed in the old profit sharing ratio. From there, I can distribute the amount, I can give the amount to the retiring partner, if any share is payable by the firm to the retiring partner. In case of a death, middle of the period lo death took place. Now, I need to calculate what? How much of amount I need to transfer to that deceased partner relating to the share of the profit of the current period. Imagine death took place before 5 months, means exactly at the end of the 5th month or 6th month or 7th month, 8th month. Now, how to compute profit? That alone is the difference for death and retirement. Next, almost all steps will be equal, sir. What I have followed for admission, same steps I will follow even for retirement, but in case of admission, I calculated sacrificing ratio. Now I will calculate gaining ratio. This is the only change, sir. Calculate gaining ratio. Goodwill calculation will have similar impact. Wait, I will show how the changes will take place in the goodwill. Third one, revaluation. Fourth one, transfer of reserves and surplus to the old partners. Transfer of reserves and surplus to the old partners. Fifth one, adjustment of capital accounts or capital balances. Calculation of gaining ratio. Sir, A and B and C are partners who are sharing 2:2:1. C is retiring from the partnership firm and they are not telling how the continuing partners will share the profits and losses. Once again, I am repeating. A, B, C were partners. 2:2:1 is the profit sharing ratio. Partner C retires from the partnership firm. Who is retiring, sir? Partner C retires from partnership firm. The other continuing partners A and B, these two were the continuing partners. If that question is silent about how they are sharing the profits and losses after the retirement of C, means if the question is silent in the old ratio only, in the old ratio they are sharing their profits and losses, means that is nothing but 1:1. If the question is silent, then the old ratio is nothing but the gaining ratio. Old ratio is the gaining ratio. Are you getting, sir? Everyone. 2 is to 1 is to 2. C retires. Question is silent. Then the remaining partners will continue to share the profits in the ratio of 2 is to 1 and the gaining ratio is 2 is to 1. Even you can also, wait, I will show how it is 2 is to 1. Up to this, okay. Next one. Old ratio 2 is to 1 is to 1. After the retirement of Mr. C, the new profit sharing ratio is 3 is to 5. The new profit sharing ratio is 3 is to 5. Gaining ratio is equal to new ratio, that is 3 by 8 minus old ratio, that is 2 by 5. Are you getting, sir? 2 by 5. New ratio minus old ratio is nothing but what, sir? Gaining ratio. Come to the next one, sir. Who is the other partner? What is the new ratio? 5 by 8 minus 1 by 5 is nothing but what, sir? Your gaining ratio. Now, whoever is the gaining partner, he is gaining the goodwill share. What he is gaining, sir? Goodwill share. Now, calculate goodwill and calculate the retiring partner share of goodwill. Retiring partner share of goodwill. Yes, sir. Retiring partner share of goodwill comes to some 10,000. How much? 10,000. Now, assuming gaining ratio is 1 is to 1. What? Gaining ratio is 1 is to 1. Entry, sir. Credit the retiring partner capital account and the debit will be given to the continuing partners in the ratio of gaining. Entry. Gaining partner capital account. What, sir? Which partner? Gaining partner capital account to debit. One more gaining partner capital account in the ratio of how they are gaining. So, retiring partner capital account. So, gaining partner capital account debit, gaining partner capital account to retiring partner capital account to the extent of his share of goodwill. This is the ultimate treatment. Sir, either the question is silent, follow this. Question asking you to not to open goodwill account, not to raise goodwill account, follow this. Question is asking you to raise the goodwill and return off the goodwill. Then what you are supposed to do? Raise what? Firm goodwill. Raise firm goodwill account debit to all partners including the retiring partner capital account. All partners including the retiring partners capital account. All partners including retiring partners capital account in old profit sharing ratio. In old profit sharing ratio. Sir, when return off is made, return off shall be given to only to the continuing partners. This is firm's goodwill. Return off will be made to the continuing partner. Continuing partners capital account to debit to goodwill. So that this goodwill asset will get closed and the continuing partners capital account debit to all partners capital account. Continuing partners capital account debit to all partners capital account. Continue means A and B. All means credit will be given to A, B, C. Ultimate net of entry will be the same entry. Ultimate net of entry is the same entry. Raise the firm's goodwill in the old profit sharing ratio goodwill account debit to all partners. cancel this continuing partners in the new profit sharing ratio. New profit sharing ratio. Ultimately, gaining is the impact value shown in your books of accounts. I hope you are getting the clarity relating to the goodwill at the time of retirement of partner. I hope you got the clarity. What will be shared, sir, to a retiring partner? No doubt his outstanding balance, capital balance. Outstanding balance is nothing but outstanding capital balance. Share of goodwill. Share of goodwill. Accumulated profits. Yes, accumulated profits will also be shared. Revaluation surplus, revaluation reserves, either surplus or loss. That revaluation profit or a loss are to be considered. Are you getting, sir? Next, the balance what is appearing in that capital account. If there is any commission, bonus or anything is, if that is also their interest, all these things adjust and the balance will be paid to whom, sir? Retiring partner. Now, how much to bring, how to bring, that will be mentioned in the question. How much to bring, how to bring, that will be mentioned in the question. JLP, already I covered, but once again I am giving JLP treatment. This is the last time I am talking about JLP, sir. Ample of examples I gave for this JLP with a conceptual clarity. I don't think any doubt is there to anyone with respect to this JLP. Death I covered. Come to retirement. Method 1. Method 1 lo neither either balance sheet asset or in the liability side JLP is not appearing, right? Surrender value will get any of the partners are retiring, you will surrender that, you will get the surrender value of the JLP. Yes, sir, I will get the surrender value of the JLP. Entry. Cash or bank account to debit to JLP account. Transfer that JLP balance, entire surrender value to the partners capital account. Partners capital account, all partners in the old profit sharing ratio including the retiring partner. I hope you get the clarity, everyone. Yes. Come to method 2. Method 2 lo balance sheet lo surrender value is appearing. Which value, sir? Surrender value is appearing, method 2. And at the time of retirement, you are surrendering the JLP, you are surrendering the JLP, you will get only surrender value. Example, cash or bank account to debit to JLP. Now the balance in the JLP account will show a zero balance. Nothing is left in that account where the partners will not get anything. This is method 2. Method 3. I am talking only in respect to retirement, not death. Only retirement. Death case I also covered. Just go and watch that video. Death I already covered, sir. Are you getting? Method 3 lo you are having surrender value and you are also having JLP reserve. Now transfer this JLP reserve to the all partners including the retiring partner in the old profit sharing ratio. Surrender value, what is there, that is only you will realize. Entry, cash or bank to JLP, JLP account will get closed. Now there is nothing to transfer to that all partners. JLP reserve amount to be transferred to the all partners capital account. Net impact wise it has no impact, sir. Net impact is almost in all these three cases is same. Then so retirement nothing is there. Problem lo they will tell like this capital, how much capital to be brought in which partner, we will to follow in the same way, right? Right. Yes, sir. One more area in partnership is Death of a partner. Death of a partner. In case of a death of a partner, all other remains the same. Goodwill, ample of time I spent on JLP. I already covered JLP. In case of death, this JLP, if you are treating it as expense, entire amount to charge it to the P&L when you are paying. In your balance sheet liabilities law, you will not have any relating to JLP. Assets law also you will not have anything to relating to JLP. Come to the balance sheet assets. Second case. On the asset side, you are having surrender value of JLP. Asset side, you are having surrender value of JLP. When the maturity taken place, now the maturity value over and above the surrender value, the maturity value over and above the surrender value will be taken to where, sir? Will be taken to partners capital account in their profit sharing ratio. Third case, surrender value is there and JLP reserve is there. JLP reserve will be taken to where, sir? All partners in their profit sharing ratio. Surrender value, the maturity value and the different surrender value will be taken to partners capital account. The difference between the maturity value and surrender value will be taken to partners capital account, and the balance in the JLP reserve account will be transferred to partners capital account in the old profit sharing ratio, including the deceased partner. Next, same death law, individual is having policies. Same death, individual partners is having policies. A, B, C. For A, 1 lakh policy. For B, 2 lakh policy. For C, 3 lakh policy. C died. Maturity value for A's policy 10,000. For B's policy, surrender value. Surrender value for A's policy 10,000. Surrender value for B's policy 20,000. Surrender value for C's policy 30,000. C died. This amount of 3 lakhs will not be belongs to C. This amount of 3 lakhs belongs to the firm. Firm means partners. This 3 lakhs C died. Amount collected. For example, 2:1 is the profit sharing ratio. 2:1 is the profit sharing ratio. Means how much that C deceased partner legal heights will get the deceased means 3 lakhs into 1/5. What is this 3 lakhs? Maturity value of the policy of the deceased partner. Now, surrender value of the other two partners, proportionate share in the surrender value of the other two partners, he will get the share. Are you getting, sir? Whenever a partner is deceased and the policies are taken on the individual names of the firm, not as a joint life policy, no doubt the maturity value of the deceased partner is the maturity value will be realized by the partnership firm, but that amount will not be given to whom, sir? To the deceased partner. That will be shared in the profit sharing ratio. And the moment that partner is dead, on the other two policies, the surrender value will be shared in proportion to the capital. Here it is 10,000, I guess. Surrender value will be shared in proportion to the capital, in proportion to the profit sharing ratio, in proportion to the profit sharing ratio. I hope you got the clarity. Whenever insurance policy, whenever insurance policies are taken on the individual names of the partners, then, sir, the amount if any partner dies, the maturity value on the policy a partner, deceased partner, that amount will not be belongs to whom? To the deceased partner. That amount belongs to partnership firm. Firm means all the partners. You have to share that amount of 3 lakhs in the profit sharing ratio. He will get 1/5. Other two policies are not matured, but on the other two policies, On the surrender value lo, this deceased partner legal heirs having a share to the tune of his profit sharing ratio in proportion to the profit sharing ratio. I hope you are getting clarity for this. Yes. One more important thing what you are supposed to be seen in this death, which is peculiar in, which is not there in other cases, section 37 of Partnership Act. What is this section 37 of Partnership Act, sir? Means section 37 is Partnership Act is telling to the partnership firm, hey, existing partners, if any partner died, settle to that legal head, settle to that estate immediately. No, sir, we are not having cash to settle this partner immediately. You are not having cash to settle this partner immediately. Then pay at the rate of 6% on the outstanding capital balance. On the outstanding capital balance. Give adjustments to everything. Whatever there in admission, whatever there in retirement, both two will be equally there in death. Along with that, the new additional point is that JLP, and the new additional point is section 37. Give effect of goodwill, give effect of revaluation, give effect of accumulated profits and losses, arrive the capital balance of the partners. Imagine some 10 lakhs is the amount partnership firm is liable for whom? To the deceased partner, legal heirs of deceased partner. Settle immediately. If you are not having funds to settle immediately, pay interest at the rate of 6% on the outstanding capital balance, or the amount of profit earned by the partnership firm, amount of profit earned by the partnership firm divided by capital employed includes this outstanding capital balance. Include this outstanding capital balance. Profit earned, yes sir, in the next immediate period you earn the profit, yes sir. Capital employed, other two capital accounts partners capital account plus this outstanding capital balance into outstanding capital balance. Give a share in the profits of the partnership firm if you are not settling. Whichever is according to option of the legal heirs of the deceased partner, settle them. Pay at the rate of 6% on the outstanding capital balance, or profit earned from which date? From the date of death to the year ending date. Profit divided by capital employed including the outstanding capital balance into his outstanding capital balance share. Capital balance includes other two partners capital share also. I hope you are getting clarity. Just I will solve one problem. Story not over here, sir. Sir, it is not like admission to tell that the partner, hey, books of accounts will be closed on 31st March or 31st December. Why can't you please die on 31st March? It is not like that, right? Books of accounts may be prepared for the year ending date. Partner may be died. First of all, even any date, we are not in a position to tell on which date the partner will die. Now, this is a period of 12 months. Partner died on exactly this date, means after 4 months. Now, it is not possible to prepare a profit and loss account here and to tell the profit for the first 4 months up to the date of death is this much. On this amount lo profit sharing ratio lo we can't share because we are not in a position to prepare profit and loss account on the date of death. Okay. The other options is on the based upon the average profits of the last 3 years. For example, last year I am getting 2 lakhs, 3 lakhs. Immediately recent year I am getting 4 lakhs. Average it, get one profit, and that profit is for how many months? 12 months. For 4 months, what is your profit? Take the average profits of last 2, 3, 4 depending upon the question and tell your what is the profit for that 4 months and give that share of that 4 months profit flow to the deceased partner, legal heir to the deceased partner. Are you getting, sir? Story not over here, sir. Sir, some cases lo you should be calculate capital balances also. To apply that section 37, you are supposed to calculate capital balances also. Are you getting, sir? What is this capital balance? I will show in the problem. I hope you are getting the clarity. Goodwill adjustment, sir. So this is all about section 37. What is the section 37 is all about? When any partner is dead, settle his amount immediately. If you are failing to settle that partner's balance, pay outstanding capital balance at the rate of 6% or at the option of the legal heirs of the deceased partner, or the profit earned from the date of death to the date when on the date of settling or the year ending date, that profit divided by total capitals, matlab that old partner's capital together with this outstanding capital balance into, for his share how much outstanding capital balance, whichever at the option of the legal heirs of the deceased partner, you can take any amount. Very good, sir. Come to the goodwill. Remember one thing, goodwill will always be there for the continuing partners. For example, A, B, C. C died. Other two partners A and B, they are the gaining partners. Now, take the firm's goodwill, calculate the share of C, and that share of C has to be contributed by the continuing partners A and B in the gaining ratio. It is not sacrificing like our old partnership admission, it is in the ratio of gaining ratio, which we have discussed even in the retirement also. How to calculate gaining ratio? If one partner is died, automatically the new ratio will be more. New ratio minus old ratio is gaining ratio. Now, this deceased partner legal heir is supposed to get that share of goodwill. Now, that amount of goodwill has to be given by continuing partners to the deceased partner. Entry. Continuing partners capital account debit. In what ratio? In the gaining ratio. Continuing partners capital account debit in the gaining ratio to deceased partner. Deceased partner capital account, the partner who is died. Are you getting, sir? You can also raise the goodwill and write off the goodwill. If they are asking you to raise the goodwill and write off the goodwill, raise goodwill to all partners capital account including C, A, B, C, firm's goodwill, A, B, C, firm's goodwill. Write off this goodwill and effect will be given to only to continuing partners. A and B are the continuing to goodwill, firm's goodwill. If you nullify, then you will get all partners capital account, all partners including the deceased partners capital account to continuing partners capital account, to continuing partners capital account, but don't follow this unless they are asking you to adjust goodwill, raise and write off. Follow continuing partners capital account debit, continuing partners capital account debit to deceased partners capital account in ratio of what, sir? In the ratio of gaining ratio. What, sir? Deceased partners shares alone you are supposed to be share. This is all about your death. Remaining everything is same. Only problem will arise to calculate the current period profit. See, in normal scenarios lo, I am in a position to prepare P&L and I can get the actual profit. But partner died after 7 months, partner died after 8 months, partner died after 9 months. Now I want to get profit for this period. It is difficult to prepare a P&L in a practical scenario. It is not that easy. If you are preparing a P&L as on this date, very much enough. Now, I want to estimate the profit. How to estimate, sir? On the basis of average profits of the last period. Right? That estimation of profit is the key here. Wait, I will tell how to estimate that. JLP, ample of time I spend on the JLP. Ample of time I spent on the JLP. JLP, whether joint life policy or individual policy. I hope you are getting the clarity. I will solve one problem which covers all the adjustments, and that is enough. You better solve one problem, additional problem, which I will tell which problem to solve, then that is enough. Exam tough oriented questions. Yes, sir. Coming to the partnership, I'll start with the newly added topics. I'll start with the newly added topics. Sir, earlier I think admission, retirement, death, all these things were there in earlier, but now those new areas were there, sir. What are the new areas is dissolution. Dissolution of partnership firm. Yes, sir. In dissolution of partnership firm, so yes, sir. In this law, with piecemeal distribution. With piecemeal distribution. Normal dissolution problems are there. With piecemeal dissolution problems are there. Okay. Normal dissolution problems lo. Normal dissolution problems lo. Sir, the partnership business comes to an end. The partnership business comes to an end. Okay. Partnership business comes to an end. Now, if I am a normal organization, continuing going concern is there in this business type of organization. If going concern is there, then I am very much interested in knowing what is the profit I am getting on sale of each asset. But when I am closing entire business, whole going concern is absent. The first step I need to dismantle the balance sheet, close the balance sheet. Now, to the partners, what and all the balance is left, I will share this to the partners. Sir, in case of dissolution of partnership, in case of dissolution of partners, sir, take one balance sheet. Sir, A, B, C. A's capital account 1,20,000, B's capital account 1,60,000, C's capital account 90,000 balance is there. And A's loan account 40,000. A's wife loan account, how much? 60,000. A's loan account, A's wife loan account 60. Now, liabilities, outside liabilities, creditors 70,000, make it as some 70. 120 plus 160, how much? 160 plus 120, 280. 280 plus 70, how much? 280 plus 90, 370. 370, 470. Creditors, make it as 30,000. Total comes to 5 lakhs, if I am not wrong. 160 plus 120, 280. 280 plus 90, 370. 370 plus 40, 410. 410, 95 lakhs. Now, I am having assets 5 lakhs. When dissolution is taking place, I need to first sell all these assets. I need to sell all these assets and I need to realize the amount and I need to pay this amount to the outside creditors first. Once I paid this amount to the outside creditors, then the balance is I am supposed to repay to this wife loan also I will repay along with the outsiders. Then I will repay if any funds are there with A's loan. Then still surplus funds are there, I will use to repay to A's capital, B's capital, C's capital. Are you getting, sir? Yes, sir. Now what I am supposed to do? Now in your books of accounts law, I am supposed to dismantle this balance sheet. I am supposed to tear this balance sheet, right? Now what I am supposed to do, sir? When this going concern is absent, open realization account. Open realization account. Realization account lo assets, you will have some assets like building, furniture, you will have inventory. Now close this assets and credit it and debit to the realization entry. Realization account debit to, it is not what you are realizing from this asset, you are supposed to transfer at book value. You are supposed to transfer at what value, sir? Book value. Now transfer your book value of the assets to the realization. Realization account debit to your assets, all your assets at book value. Okay, sir. Book value, book value, book value. Now transfer your liabilities, leaving this capital account. Sir, take some reserves also. Take one reserves and surplus also. Accumulated profits. Have accumulated profits also. So now come to the liability side of balance sheet. In the liability side of balance sheet lo, close your creditor account, close A's wife account, close the loan account. Now in this entry, liability account to debit, liabilities account to debit to realization account. Close the liability and it transfers to realization account. Realization account lo by liabilities, by liabilities, by liabilities. Transfer all your assets to where, sir? To realization. Transfer all your liabilities to where, sir? Realization. Point number 1. Open your capital account. Open your capital account. Open your capital account. Capital account lo you will have ABC, you will have ABC. You will have A capital, B capital, C capital, and you will also have A's capital, B's capital, C's capital. By balance brought down. By balance brought down. How much is the balance brought down? 120, 160, 90. 120, 160, 90. 120, 160, 90. This is what, sir? This is the balance of opening balance of your partners. Next, sir. Immediately in this accumulated profits, whatever is there, this accumulated profits transfers to where, sir? This accumulated profits transfers to partners. Accumulated profits transfers to your old. Imagine some 1 lakh is there, that 1 lakh will be transferred in the ratio of 2:2:1, means 40, 40, 20. Transfer this accumulated profits 40, 40, 20. Done? Done, sir. Now the next step, sir. Sir, transfer all your assets to realization. Transfer all your liabilities to realization. First transfer is done. Done. Next step, transfer your capital to the respective capital accounts. Transfer accumulated profits to the capital account. Next, sir. Next step is to, sir, you will realize this asset. Yes, sir, I will realize. Now, for example, book value of assets is 1 lakh and asset realized total is 1,20,000. How much you are realizing, sir? 1,20,000. Entry, sir. Actual entry is bank account to debit to asset account, but you are debiting bank and the credit will be given to whom, sir? Asset is not there. Asset is there in where? Asset is there in the realization account. Credit the realization account. Credit the realization account. 1,20,000, 1,20,000. Come to the next step. Sir, realization account lo entry, sir, by bank. By bank. Come to the next step. What is the next step, sir? Next step is payment, settlement of your liability. Settlement of liability. Settlement of liability. So what is the settlement of liability, sir? Sir, liability comes to 1,40,000, sir. I settled maybe 140 or less than 140. Predominantly, I will not settle more than 140 for sure. If I settled 140, actual entry creditor account debit to bank account. But here, realization, creditor account is there or not there? Creditor account is there in which account? Creditor account is there in the realization account. Entry, realization account debit to bank account. Realization account debit to bank account. One more entry, sir. Sir, one more entry is, sir, if I paid less than that book value is 120, I paid only 1 lakh. What is the balance left? 20,000. Sir, this 20,000 will automatically booked, sir. Wait, I will show how it is automatically booked, that profit. First one, what I did, sir? Transfer all my assets to which account? Realization. Close the asset account. Realization account debit to asset account. Done. Transfer all your outside liabilities and transfers to realization. Entry. Realization account debit to, I am supposed to be cancel my liability, debit your liability, credit your realization. Entry. Debit liability account debit to realization. Realization lo credit side. Are you getting, sir? Run. In the realization lo credit side. Once you make a payment for a liability, actual entry creditor to bank, but here realization to bank. Once you are receiving cash, entry cash account to debit, yes sir, cash account to debit to asset account, but here cash or bank account debit to realization. So realization lo by cash or bank. Next one, sir. Transfer all your assets to where? To realization, liabilities to realization, capital to the capital accounts, accumulated profit to the capital accounts. Don't transfer your cash balance. Note. Don't transfer cash balance. Don't transfer cash balance. So the cash balance what is left? Don't transfer to where, sir? Don't transfer your cash balance to the realization account. Now when you are collecting cash, cash account debit to realization, when you are paying liability, settling entry, liability account matlab realization account debit to cash, the balance left in where? In your cash account, it will equal to the amount payable to A, B, C. The balance left in the cash account will equal to the amount payable to A, amount payable to B, amount payable to C. This is what, sir? Simple dissolution. So in a dissolution where you are having what? Assets, where you are having what? Liability, and you are having what? Accumulated profits, and you are having capital accounts. First, what you are supposed to do? Close your all assets account and transfers to where? Realization. Entry. Asset will have debit balance, to close credit it, debit. Realization account debit to assets, yes. Creditor account debit to realization, yes. Collection of cash, entry. Cash or bank account debit to realization, yes. Payment to creditors, entry. Realization account debit to cash or bank. Done. Now the balance in your capital account will exactly match with what? Cash account. Done. Next, sir. Now special points came, sir. First one, sir. First special point is asset to taken over by partner. Asset taken over by partner. If an asset is taken over by partner, what I am supposed to do, sir? An asset worth 10,000. Taking by whom? Taking the partner. Valuing how much? Valuing 6,000. Entry, sir. Now the book value of the asset comes to how much? 10,000. But I am taking at what price? 6,000. Second one. Sir, partner loan is there. What, sir? Partner loan is there. Partner wife loan is there. Partner wife loan is there. Partner loan is there. And debit balance in what, sir? Debit balance. Debit balance in where, sir? Partners capital account. Debit balance in partners capital account. First one, partner loan is there. Yes, sir, partner loan is there. Transfer this partner loan to realization. Transfer partner's loan to realization account. Yes, sir, transfer partner's loan to realization account. Okay, done. Whether the question is telling expressly or not, you are supposed to do what, sir? You are supposed to make a payment for this. Whether the question is telling or not, you are supposed to make a payment for this. Next, sir, partner wife loan is there, sir. When partner wife loan is there in the balance sheet means, then if in the problem they are telling partner wife loan is taking by the partner entry, sir. Transfer this partner loan to where, sir? Transfer partner loan to partner capital account. Transfer partner loan to partner's capital account. Point number 3. Balance sheet lo, sir, in the balance sheet they are having A's capital account. Balance sheet lo A's capital account is there in the asset side means what is that meaning? Partner is having a debit balance. Yes, sir, partner is having a debit balance in the asset side. Now what you are supposed to do, sir? Will I need to transfer realization? Partner loan means I transfer to realization. Why? Because I am not supposed to treat with this partner's loan in par with the capital. So I am transferring this to where, sir? I am transferring that partner loan to the realization. But partner capital account lo debit balance is there means the debit balance what is appearing in where? In capital account should be transferred to where, sir? Capital account. Should be transferred to capital account. Should be transferred to where, sir? Capital account. So what is the essence of the discussion? First one, partner loan. Take to where, sir? Partner loan. Take to realization. Take to realization. Next, come to the next one. Next one, sir. Wife's loan. Partner wife's loan. Partner wife's loan. If partner's wife's loan and debit balance asset side. Debit balance. Debit balance in where, sir? Debit balance in the asset side. Debit balance in the asset side. Asset side. Debit balance of what, sir? Asset side debit balance of partners. So if you are having debit balance of partners capital in the asset side, transfer this to where, sir? Transfer this to partners capital account. Why means if you are transferring to the asset side of realization, he will not give cash, sir. He will obviously will tell to settle against the capital account. If you are taking to the realization account, now that cash will not come, it will show a loss which will be shared by all the partners. Don't do that. Don't do that. Okay. Now partner loan is there. Next one, partner wife loan is there. Partner loan take to where, sir? Partner loan take to realization. Partner wife loan, sir. Partner wife loan take to the, if partner is taking, if I want to take my loan, then transfers to capital account. If that is not there, then take to where? Realization. Take to realization. Sir, unrecorded asset is there. Unrecorded asset is there. Unrecorded asset is realized. Don't take in the realization account. Don't take in the realization account. Take in where, sir? Take in the credit side of realization. Unrecorded asset is there. And unrecorded liability is there. Sir, unrecorded asset is there, unrecorded liability is there. Neither, don't take these two in where, sir? Realization. When they are realized, take it on the realization. Cash account debit to realization, realization credit side lo realize. When you are settling this, take it on the realization. Don't take it, and once again don't record this. The net impact will remains the same. So unrecorded asset, unrecorded liability, don't take in where, sir? Don't take in your realization. When you realize that cash, take that in the realization. When you settle this liability, take this into realization. Next one. Next one, sir. Sir, unrecorded liability is there. That unrecorded liability, I am settling at a lesser value. Will I need to take? No, 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 no. Unrecorded asset is there, and I am realizing a lesser value. Will I need to record in that the loss? Not required, not required, not required. Directly take the proceeds and throw it in where, sir? Realization. I hope you got the clarity. Yes, sir. Now, one asset is there, book value. How much is the book value, sir? 10,000. Now, this asset is taking by the partner. Asset is taking by the partner. One liability is there. Liability is taking by whom, sir? Partner. Directly adjust in where, sir? In partner's capital account. Directly adjust in where, sir? In partner's capital account. Asset book value how much? 10,000. Now partner is taking that asset. Now credit that asset, debit partner's capital account. One way of treatment. No, sir. Second way of treatment is debit that asset. For example, book value is different, settlement value is different. Book value is 10,000. How much, sir? Book value is 10,000. Now, partner is agreed to take for how much? 8,000. First, what you are supposed to take, sir? Throw this asset into where? Realization. Throw that asset into realization. Entry, sir. Realization account debit to asset. To asset. How much? 10,000. Throw it into where, sir? By partner capital 8,000. So that the loss of 2,000 will be adjusted to the all the partners account, all the partners capital account. Right? Come to the next one. Sir, I am having one liability. Transfer that liability by to liability to what, sir? To realization 10,000. Now one of the partner is settling that liability at 8,000 by cash. Instead of writing cash, by capital. Which partner is taking? That partner 8,000. Automatically the gain is booking in where? Realization account. I hope you got the clarity, sir. I hope you got the clarity. Now simple procedure. Open realization account. Next, the profit or loss arising from the realization transfers to whom, sir? The profit or loss arising from the realization will be transfers to all the partners in the old profit sharing ratio. Yes. Next one. Now the immediate step is to open that realization and complete the transfers. Now transfer all assets except debit balance of profit and loss account and any partner's current account. Transfer all liabilities. Transfer all liabilities to where? To realization, including partner's loan. If partner's wife's loan, partner assumed that I will take, throw it on the partner's face. Next, don't transfer what? Cash account. Now the cash what you have realized, settle for what? Settle the, realize the asset. Realize the assets, you will get cash account debit to asset, but don't credit asset because the assets are there in realization. Entry, cash or bank account to debit to, cash or bank account to debit to, credit will be given to whom, sir? Credit will be given to realization. Next one, sir. Next one. When you are making payment to the outside, settlement of outside liabilities. Entry, creditor account debit to cash, but creditor is not there here. Entry, realization to cash or bank. Realization to cash or bank. Ultimately, the balance left in where? In the cash will equal the what? Capital account lo. How much is amount payable to the partners in capital accounts? Amount is payable to partners in capital accounts. Open capital accounts and transfer your accumulated profits or losses to where, sir? To the capital, to partners in old profit sharing ratio. This is the simple concept of dissolution. Are you getting? In the balance sheet lo, you will have all the assets, so don't look anything, transfer that to realization. Whether partner is taking that or partner is not taking, I am not bothered about. I take all the assets into what? Realization. Take all the liabilities into what? Realization. Asset size lo, accumulate balance of P and L losses, don't take. Any partner current account, don't take into realization. Liabilities lo, don't take accumulated profits. Liabilities lo, don't take partners balances. Liabilities lo, don't take any wife's loan is assuming by the partners. Any other liability is taking, throw it into what? Realization, and then realization to transfers to what? Capital. Asset book value 10,000. Taking partner at 8,000. Transfer that asset book value at 8,000. Throw this to capital in realization at 8,000. Entry, sir. Realization to asset. Yes. Partner capital account 8,000 to realization. Partner capital account 8,000 to realization. I hope you get the clarity. Right? Right. One simple problem you can solve and we can get the command over the problem. Unrecorded asset don't take now. If you are realizing some amount from the unrealized asset, don't take in where, sir? Don't take in the debit side. Matlab, don't take that you amount what you realized. That only consider now. For example, 10,000, 12,000, two assets are there. Total 22. But one unrecorded asset is there 4,000. Total you record 26,000. These both assets into what? Realization. Assets is having what balance? Debit balance. Throw both these assets into what? Realization. Entry. Realization to assets. How much? Only 22. That is the book value you need to close. That is the you need to close. How much you are getting cash? Cash account debit 26,000 to realization account. Cash account debit to realization account. How much, sir? 26,000. So take to the credit of realization. Unrecorded asset. Same way unrecorded liability. Don't take that book value. What you settled, that only take it in your realization account. I hope you get the clarity. Yes, sir. Next, one more important topic in partnership is treatment of JLP. Sir, what is this treatment of JLP? First one. Sir, treating it as expense. Treating it as expense. Okay, sir, we can treat this as expense. First of all, tell me what is this JLP? JLP refers to joint life policy. If this joint life policy JLP, who is taking? Partnership firm is taking. Who is taking? Partnership firm is taking. On whom? On the life of members, on the life of partners, on the life of partners. Who is paying? Partnership firm is paying. For example, A, B, C. 3 partners were there. Partner C died. Partner C died. Remaining 2 partners A and B. Imagine the policy value comes to 10 lakhs. Now the deceased partner C is there. Most of them is an impression that this entire 10 lakhs belongs to this guy who is died. No, sir. First, this amount belongs to partnership firm. This amount belongs to whom? This amount belongs to partnership firm. That is the first thing. Who paid every month? Partnership. Every year who paid the premium? Firm paid the premium. In case of death of a partner, who will get the amount, sir? the deceased partner will get the amount. Right? Right. Now what you are supposed to do? Sir, I am taking one joint life policy. Maturity value is 10 lakhs. Every year you are supposed to pay 1 lakh for a period of 9 years. Year 1, 1 lakh. Year 2, I need to pay 1 lakh. Year 3, I need to pay 1 lakh. Year 4, keep on, I need to pay for 9 years. This is what I am supposed to pay. Next, there is one more concept which is known as surrender value. The surrender value for that end of the year 1 comes to 10,000. Example, assumption. Surrender value at the end of the year 2 for this policy comes to 24,000. Surrender value for at the end of year 3 comes to 40,000. So these are the surrender values for that policy. First year I am paying how much? 1 lakh. Second year how much I am paying? 1 lakh. Third year how much I am paying? 1 lakh. First one. When you are treating it as expense, then you are nothing to bother about surrender value. If you are treating this as asset, then only surrender value will come to the picture. If you are treating this as expense, there is no need to bother about what is your surrender value. JLP expense account to debit to cash or bank. JLP expense account debit to cash or bank. This is year 1. How much? 1 lakh. Transfer this entire 1 lakh to, if it is a rent expense, if it is a salary expense, if it is a insurance expense, you are transferring this to where, sir? I am transferring this to P&L. Same way, at the end of the year, transfer this JLB expense to where, sir? To profit and loss account. Profit and loss account to debit to JLP expense. How much? 1 lakh. 1 lakh. Come to the year 2. Year 2 lo how much I paid? Same 1 lakh entry. JLP expense or JLP account to debit to JLP expense or JLP account debit to cash or bank. How much? 1 lakh. Transfer this entire 1 lakh to at the end of year 2 to P&L. P&L account to debit to JLP expense. How much? 1 lakh. 1 lakh. Come to the third year. Third year also I paid expense. What is the entry? JLP expense account to debit to cash or bank. How much? 1 lakh. Transfer this to the profit and loss account at the end of the year 3. What is the entry for that? Profit and loss account to debit to JLP expense account. How much? 1 lakh. 1 lakh. Profit and loss account debit to JLP expense account. 1 lakh. 1 lakh. Very good, sir. Next, sir. Next, sir, what happened? Fourth year lo partner died. I gave the policy. Now I will get the maturity value of the policy. What is the maturity value of this policy? 10 lakhs entry. Cash account to debit to JLP account. How much? 10 lakhs, 10 lakhs. Transfer this entire JLP amount. Why? Because in the books of accounts law, you are not having an account called JLP account. Now in your books law, JLP account is showing a zero balance. Entire 10 lakhs is your gain. Will be transferred to where, sir? Partners capital account. JLP account to debit to partners capital account in the profit sharing ratio. 10 lakhs. If in our case lo 3 partner means A's capital, B's capital, C's capital. If it is 2:1 means 4 lakhs, 4 lakhs, 2 lakhs. The same entry holds good. Which entry? Directly you can pass cash to A, B, C also. Direct entry also is fine. This is when, sir? When you're treating this as expense. Sir, when you're looking into the problem, how to find out whether you're treating it as expense or asset means in your balance sheet asset side low, if there is no JLP account, then you're treating it as what? Expense. Right? Super, sir. This is in the case of debt. Next. When it comes to the next method, sir, what is the next method? Method 2, treating JLP as asset. In our earlier method law, I treated JLP as expense. Now in this method law, I am treating JLP as the asset, sir. When you are talking JLP as asset means, now you spent on the investment 1 lakh at the year 1. You spent 1 lakh. But the surrender value only 10,000. What happened to that 90,000 is loss. Is lost only. You spent how much? 1 lakh. At the end of the year, they will give you how much? 10,000. What is it? Now, at the end of the first year low, you will show your JLP as asset in the balance sheet at what amount? JLP at 10,000. Entry, sir. JLP account to debit to cash account. How much? 1 lakh, 1 lakh. Second one, sir. You paid how much? 1 lakh, but the market value, in other words, the surrender value is only 10,000. Loss is how much? 90. Transfer this loss to where? P&L account to debit. P&L account to debit to JLP account. P&L account debit to JLP account. How much? 90,000. Now in your balance sheet low, you are showing your JLP asset at what value? At 10,000. Year 1 done, year 1 done. Come to the year 2. Year 1 low, balance sheet low, asset side, JLP is showing at 10,000. Next. Come to the next method. Next in the same second year. Year 2 lo how much you paid? JLP account to debit to cash account. How much you paid? 1 lakh. How much you paid? 1 lakh. Immediately the moment you paid, your JLP value will comes to how much? Year 1 low, the surrender value 10,000. If you open that account, to balance brought down 10, to cash or bank 1 lakh, total 1 lakh 10,000 is the value. As of now, the book value of the JLP at second year 1 lakh 10,000. But the surrender value, it is the cumulative surrender value, which comes to how much, sir? If I am not wrong, 24,000 in the example I said. Yes, 24,000. 24,000 is the surrender value at the end of the second year. Now in the balance sheet lo, I will show as asset JLP at the end of the second year as how much? 24,000. But how much I paid? What is the book value, sir? Everyone, how much is the book value? 1,10,000. Very good. And the surrender value how much? 24,000. Yes, sir. What is the difference, sir? Yes. What happened to the difference? Yes. Now, the difference will be transferred to where, sir? Profit and loss account to debit to JLP account. How much? 84,000. 84,000. Now in the books lo JLP account is showing how much, sir? 24,000. Up to this okay. Come to the year 3. You paid how much? 1 lakh. Entry, sir. JLP account to debit to cash account. How much? 1 lakh. 1 lakh. Second one, sir. Now as on today, already opening balance 24. I paid 1 lakh. The total amount should be 1,24,000. How much? 1,24,000. But the surrender value how much, sir? 40,000. The surrender value comes to how much, sir? 40,000. What is the loss? 84,000 is the loss. Loss will be transferred to where? Loss will be transferred to profit and loss account. Transfer. Profit and loss account to debit to JLP account. How much? Profit and loss account debit to JLP account. How much, sir? 84,000. Now what is the next step, sir? Now come to the year 4. Partner died. You are getting 10 lakhs. Entry, sir. Cash or bank account to debit to JLP account. How much you are getting? 10 lakhs. What is the balance in the JLP account? The balance in the JLP account, 40,000 is already there, debit balance. Credit balance, how much you are getting? 10 lakhs. What is the extra? 9 lakh 60 is there. Transfers to the partners A, B, C in their profit sharing ratio. How much you are supposed to share? JLP account to debit. The difference between maturity value and the book value. How much is the difference between? The difference between maturity and the book value, 9 lakh 60. How much, sir? 9 lakh 60,000 will be transferred to where, sir? To A capital, to B's capital, to C's capital, A's capital, B's capital, C's capital. Done, sir. In the ratio of what? Profit sharing ratio. 9 lakh 60,000. I said it is 2:2:1. Then which comes to 3 lakh 84. 3 lakh 84. 1 lakh 92. This is which method, sir? Second method. In the event of death I am talking. Come to the third method. The main drawback in method 2 is first year lo how much you debited to P and L? 90. Second year lo how much you debited to P and L? 84. Third year lo how much you debited to P and L? Third year is also 84. Okay. But there is a fluctuation. Maybe in the fourth year low, still surrender value will change. If the partner is not dead, that P and L low there is a fluctuations. Method The disadvantage of method 2 leads to a forming a new method, that is method 3. What is that means? There is a fluctuations in P and L account. Because of the changes in the surrender value, your P and L account you are showing that impact. Don't show that surrender value loss impact in your P and L. Better show that surrender value impact in a separate reserve account. Right? Right. What they are telling means maintain one reserve, maintain one JLP account, means both they are maintaining. Both means what, sir? They are maintaining one asset and they are also maintaining what? One reserve. They are maintaining one asset and they are also maintaining one reserve. Sir, if they are maintaining asset and also the reserve, what is this reserve? How much I paid in the year 1? 1 lakh entry. JLP account to debit to cash. How much? 1 lakh, 1 lakh. Second one. Immediately transfer equal amount what you have paid from where to where? From P and L to JLP reserve account. From where, sir? From P and L to JLP reserve. From JLP reserve, any fluctuations in the surrender value, you have to adjust in the JLP reserve but not in the P and L. Example, sir, 10,000 is what? Surrender value. Loss in the value of asset comes to 90,000. In our earlier case law, I am debiting this 90,000 to P and L. Now, don't debit 90,000 to P and L, debit that 90,000 to JLP reserve. JLP reserve account debit to JLP account. How much? JLP reserve account debit to JLP account. 90,000. If you open one balance sheet at the end of the year 1, JLP account lo will show a balance of 10,000. JLP reserve lo will have a balance of 10,000. JLP lo you are having a balance of 10,000. JLP reserve lo you are having a balance of 10,000. I hope you got the clarity relating to the regarding this. This is method 1. Are you getting? Yes. Come to the year 2. First one, payment entry. Now the JLP asset is showing balance how much? 1 lakh. But now I created JLP to the net worth of 90. You are having JLP account lo balance 10. Reserve lo 1 lakh. Divided that reserve to the tune of 90. You are having a balance of 10,000. Come to the year 2. Year 2 lo how much you paid? 1 lakh entry. JLP account to debit to cash account. How much? 1 lakh, 1 lakh. Next step, immediately transfer this amount from where to where? From P and L account to debit to JLP reserve account. How much? 1 lakh, 1 lakh. Now, at the end of the year 2, you are having book value of JLP 1 lakh 10,000. But at the end of year 2, the surrender value is 24,000. How much is loss? 86,000. Transfer that 86,000 to from where to where? From JLP reserve to JLP. JLP reserve account to debit to JLP account. How much? 86,000. 86,000. If you prepare a balance sheet now, under the asset side low, you are having an asset called JLP asset on the asset side. How much? 24,000. I hope you got this clarity. How much is the JLP asset? Surrender value 24,000. Now, JLP reserve at the end of the first year, you are having balance 10,000, 1,10,000. I debited 86. JLP reserve you are having a balance of 24,000. JLP reserve you are having a balance of 24,000. Come to the year 3. How much I paid? JLP account to debit to cash or bank. How much? 1 lakh, 1 lakh. Next, immediately transfer from where to where? P&L to JLP reserve. How much? 1 lakh. Entry. P&L account to debit to JLP reserve account. How much? 1 lakh, 1 lakh. Now, 1,24,000 is what, sir? Is your balance in your JLP account. Surrender value how much, sir? 40,000. Now, how much is the difference? 84,000. Right? What is this 84,000? This 84,000 is the loss. Transfer from where to where? $90. 86. Yes. Yes. Now, how much? This comes to transfer from where to where? From JLP reserve to JLP. JLP reserve account to debit to JLP account. How much, sir? 84,000. 84,000. Are you getting? I hope you got the clarity relating to this. Now, can anyone tell what is the balance in JLP? Surrender value, which is nothing but what? My JLP surrender value in the balance sheet 40,000. JLP reserve 40,000. Year 4 low, partner died. Share this JLP reserve low balance to the all partners capital account. How you are sharing what? How you are sharing your accumulated profits and losses? In the same way, transfer these reserves to the existing partners, including the deceased partner, in the old profit sharing ratio. Now come to the JLP. The book value of the JLP is 40. Now over and above the book value, transfer from where to where? From JLP to partners capital. First, record the receipt entry. Cash account to debit to JLP account. How much? 10 lakhs. The balance in the JLP account how much? Now, the difference between surrender, the difference between the maturity value and book value. The difference between maturity value and book value how much? 10 lakhs is maturity, 40,000 is book value. The difference 9,60,000 will be transferred from where to where? Will be transferred from JLP to partners capital account. Entry. JLP account to debit to partners capital account. A, B, C. Are you getting, sir? How much? 9,60,000 if I am not wrong. Just now we have seen 3,84,000. Yes, 3,84,000, 110. 3,84,000. 3,84,000. Sir, in all the three cases, the amount transfers to partners capital account is same. You don't think in the first case you are transferring 10 lakhs, second case you are transferring 960. No sir. You check with the capital accounts how much you debited to the partner's capital. How much you debited to the partner's capital in the ratio of profit sharing ratio. Exactly in all the three cases you will share the same amount. Right? This is all about JLP in the event of death. The same JLP in the event of retirement will also be there. Yes sir. Wait, I will tell what is the same treatment, slightly changed. That's it. This is the in the case of death. Now come to the retirement stage. Sir, I hope you got the clarity over JLP, right? Right. Sir, it is not JLP. Firm is taking individual policies on the partners. Partner A, partner B, partner C. So, firm is taking individual policies on the partners. It is not JLP. On A, firm is taking a policy for 2 lakhs. On B, firm is taking a policy for 2 lakhs. Maybe it may be 2, 3, 4, depends sir. Just I am taking for convenience sake 2 lakhs. Or with different values also. Very good. A died. Surrender value for this is 5,000. Surrender value for this is 5,000. A died. Now, A legal heirs will get no doubt, for example, profit sharing ratio 2:2:1 profit sharing ratio. No doubt maturity value that A insurance policy 2 lakhs will get 2 lakhs into 2 lakhs into 2/5. That is what he share. Next, on B, it is not for B, on B, A's legal heirs, how much A's legal heirs will get? On B, surrender value 5,000 into 2/5. On C, surrender value 5,000 into your share is 2/5. Are you getting? I hope you got the clarity. If it is a joint life policy, what I have said so far, you are supposed to treat asset account, revenue, all these things. If it is individual policies, yes sir, these are individual policies taken on the life of the individual partners. Partner deceased, then what you are supposed to take? Surrender value of continuing partners. On the continuing partners policies low, on the surrender value, you are supposed to take what? Proportionate share of the deceased partner. I hope you got the clarity. A, B, C were 3 partners sharing profits and loss in the ratio of 2:2:1. A has took one insurance policy on the A's life for 2 lakhs, on B's life for 2 lakhs, on C's life for 2 lakhs. Maybe it may be taken on the different proportion 1, 3, 5, 1 lakh, 3 lakh, 5 lakh, 5 lakh, 4 lakh, 3 lakh. It depends upon the policy. For convenience sake, I took like this. Okay. Now, on this A died, policy matured, firm is receiving 2 lakhs. Entire 2 lakhs I will not give to whom? A. Why? This is firm's policy, not individual partner's policy. Firm is taken on the individual life. Now, any profit of the firm has to be shared in the ratio of profit sharing ratio. Share this in the ratio of profit sharing ratio. 2:5. On the, this policy is not matured. Surrender value need to be shared between all the partners. So, now A ratio is 2:1, 2:2:1 matlab 2/5. On this 5 lakhs also 2/5. This is what the individual policies, when they are taking individual policies. I hope you got the clarity. JLP in the event of retirement. In the event of retirement, now the policy is not matured. The surrender value need to be shared between all the partners. In what ratio? In profit sharing ratio. In profit sharing ratio. In method 2 lo and method 3 lo, method 2 and method 3 lo, method 2 surrender value, method 3 surrender value is already there in where? In the balance sheet. Don't take anything to where? Anything to the partner's capital account. Bank account debit to JLP, so that the JLP account will get closed and you will not have any balance left in the JLP. Don't take any amount to the individual partner's capital account. When it is method 1, then the surrender value will be shared between what? Between the partners in what ratio? In profit sharing ratio. Simple. First one, JLP treating it as expense, charging to P&L. JLP account itself is not there in the balance sheet either in the form of reserve or in the form of investment. It is directly what they have considered, charging to P&L. In case of retirement, the surrender value has to be given to the partner's capital, credit to partner's capital. In case of death, the matured value is supposed to be given. Come to method 2. In the debit side, surrender value is there. Partner died. The difference between maturity value and the book value, in other words, the difference between the maturity value and the surrender value is the profit, shall be transferred to partner's capital in the profit sharing ratio. Method 2, partner retired. Now, surrender value only you are getting, cash account debit to the surrender value, then the individual partner's account will not be credited with any amount. Simple reason I said, because the debit impact will be the same. You don't think in the method 2 they are not getting nothing, they are getting in the form of debits. If you check your debits, how much you are debiting to the capital accounts, pakka it will tally. Method 3. In the liability side, JLP reserve is there. Asset side, JLP is there. The balance in the JLP reserve account will be transferred to where? Will be transferred to partner's capital account. The balance in the JLP reserve will be transferred to partner's capital account in what ratio? In profit sharing ratio. Whether it is a death or it is retirement. If it is a death, the maturity value over and above the surrender value or book value will be transferred from the JLP account to partner's capital account. In case of retirement, nothing will be transferred. When you compare with all the 3 methods, net amount going to partner's capital account is same. You can also check. I will show this. Wait. I hope you got the clarity. Individual policies. A, B, C, 5 lakhs, 10 lakhs, 15 lakhs. I have took in the same ratio, 5 lakhs, 10 lakhs, 15. Okay. 10 lakhs guy died. 10 lakhs received. That 10 lakhs will not be given to the individual guy. It is the amount of the partnership firm will be shared in the profit sharing ratio between all these 3 partners. Surrender values of the continuing partner will be shared in the proportion to profit sharing ratio of the surrender value of the continuing partner in the proportion of profit sharing ratio will be shared to the legal heirs of the deceased partner. I hope you got the clarity on this.